has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Live from New York City this morning. Good morning to you all on TV and radio. Here's the price action. We're negative 0.5% on the S&P. On the Nasdaq 100, down 0.4%. A whole host of cuts to the global growth outlook. Yesterday, the World Bank at 2.9%. The OECD just about holding on to a 3% for global growth over the next year or so. We'll talk about that with the OECD in just a moment. That's the equity picture. Bond market story looks like this. 2s, 10s and 30s in America. Yields lower yesterday. Big question about whether there was a disinflationary element to the target story yesterday. Maybe we can touch on that a little bit later. Yields higher again this morning, though, up by 3 basis points, back through 3% to 3.0067%. Won't spend too much time on this. I want to turn to foreign exchange and get you set up for the ECB. The ECB two-day meeting starts a little bit later. We'll hear from them tomorrow. Expected to lay the groundwork for a hike in the following meeting, and maybe even the one after that, the one after that, and the one after that. Euro dollar just a little bit stronger here at 107.09. That's where you get some strength in the FX market against the dollar today, because elsewhere there's some real dollar strength, particularly against the Japanese yen. Dollar yen 133.93, staring down 134, and levels we haven't seen since the end of February 2002. That currency pair, Tom, positive 1 full percentage point as the rest of the world, much of the rest of the world, starts to think about hiking interest rates, following the Fed, doing what EM's been doing for a whole lot longer. Tom, as they do that, the BOJ is looking increasingly isolated.
I would say, John, the summation of our guess is a 135 level is a round inconvenient statistic where maybe things start unraveling for Mr. Kuroda and the Japanese financial system, maybe just picking 1 point as suspect off dollar yen, but the rate of change here is enough to get Laurent Spoon going.
What do you think they do, Tom, in response to that? Do they let go of the cap on a 10-year JGB? What do you think they do in response to that 135?
I will defer to the late and fabulous Martin Feldstein, who was dismayed, John, at the cultural slow-motion exercise when they cleared the banking system. Why would this be any different? They got to clear out the zombies. They got to be efficient. But I'm going to say this till I'm blue in the face. This is not your father's yen story. They have a trade deficit. They're getting crushed by import dynamics.
And as Lisa has said a couple of times, Tom, I don't think we can even call some of this a market. Dollar yen right now, Tom, 133.93.
This could be a 1-hour conversation. It is so good, and she is so qualified. She's chief economist at OECD. Laurent Spoon joins us now on a trip around the world. And Laurent, I'm going to be selfish and go to the growth recession you call for in the United States, where you've got an ugly statistic, and then the next year it gets uglier for the United States. Well, take that out to a global economy and the benchmark you and I studied in school of 3% global growth as being lousy. Is our global economy heading or in a growth recession?
Well, hi, Tom, and thanks for inviting me. The global economy is paying a very hefty price for the war that Russia is leading into Ukraine. And yes, this is pushing down growth quite a lot to 3%, as you say, which is just about one of the low rates we have seen. And it's pushing inflation even higher. We're getting close to 9% or a little more than 6% if we're excluding Turkey in the OECD economies.
Do you ascribe to the idea that the only way to break Lawrence Summers stagflation, the only way to break this, given the war and given the rest, is tight monetary policy? Is that the only way you get this done?
So I think we have a little more messages than this in there. As far as monetary policy is concerned, we have, still healthy growth, employment, and high inflation. So what we're saying is remove some monetary policy accommodation. Monetary policy, as you very well know, cannot address supply shock, but they can signal that they will target this, by telegraphing what they're doing. And in those countries where there is obvious excess demand, then yes, monetary policy should be tighter.
Laurence, what's the main swing factor that led to the downgrade and that could potentially lead to more downgrades ahead?
So the main swing factor is really Russia's aggression into Ukraine. As you know, we were already having inflation going up because of the pandemic and the issue with China's supply chain and zero COVID policy. So that was already affecting us. Now, the disruptions and the cut to the production of cereals, of energy coming out of the war is obviously raising inflation. And this higher inflation is undermining consumer confidence and therefore consumption. One of the things we say, if you allow me just a 30-second sentence on this, is it has the burden of inflation, the cost of the war, should be fairly shared between employers and employees, wages and profits, so as to avoid a wage price spiral.
So this is one of the reasons why perhaps you accuse the United Kingdom of having taxes that were too high and saying that they had to cut them in order to give people more buying power. How much does there have to be, in some ways, fiscal expansion, despite the idea that people are pointing to some of the fiscal expenditures as being the cause of inflation?
Well, there are several reasons why the UK has lower growth than other G7 economies next year. One is the higher inflation. The other is tighter and faster monetary policy tightening, and also faster fiscal consolidation. So what we're recommending to the UK is actually to consider the pace at which fiscal consolidation is taking place if growth was too slow, as fast as what we're describing.
Laurence, the OEEC is part of the alphabet soup of the OECD, are the people that actually prosecuted the Marshall Plan. How do you respond when we hear so many people in a flippant way say what we need is a new Marshall Plan on Ukraine and the rest as well? How does OECD and you actually feel we will affect a modern Marshall Plan?
So I think there are two things. One is what's happening in Ukraine, where, as we can see, everything is being destroyed, all the infrastructure, and so a large part of the infrastructure and the capacity, the productive capacity of the economy, and this will need to be rebuilt. The Marshall Plan goes hand in hand, as you very well know, Tom, money on the one side, but also reform, structural policy reform on the other hand, to ensure that the money is very well channeled. So that's one thing. The other thing I think people have in mind more immediately at the moment, and that we have in mind at least, is globally to avoid a food crisis. And for this, we're just saying a couple of things. One is ensure the transport and logistics of the cereals around the world so that it reaches Middle East and Africa, where it's most needed, where it could cause not only starvation, but also social and political unrest. And for this, we might need more foreign aid, which in a sense is also part of what we call Marshall Plans.
Laurence, you've got a whole host of policy prescriptions, and I just wanted to finish on the UK because you do offer some advice to the British government. Out of the developed economies at the moment, that's the one that seems to be really fighting with low growth and much higher prices in a much more pronounced way than, say, the United States or Europe for that matter. Can you run us through your thoughts on what you think this government should do right now?
I can try. What makes the UK different from other G7 economies? As I was saying, higher inflation, faster tightening of monetary policy, but also faster fiscal consolidation. And then the disruption to manufacturing supply chain, as we know, between China and some of the Brexit discussions. So there are two things, I think, which stand out. One is to carefully weigh what's happening with fiscal policy and make sure that not only the most vulnerable, but the working class just above the most vulnerable is actually being sheltered from the cost of war. And the rise in global oil prices is affecting everyone, as we know. And the second thing that we're saying is obviously trade has to resume faster in the UK.
Laurence Boone, thank you. Thank you very much. From the OECD, looking for 3% global GDP. Over at the World Bank, looking for 2.9 and looking for 134 right now in dollar yen, 133.99, Tom, getting very, very close to that level on my screen.
These are the rate of change we're seeing today, and it can be idiosyncratic like dollar lira. John, yen is not idiosyncratic. It folds in. I get the domestic focus, John, as you mentioned, with the fiction of their managing of yield as well. And at some point that's going to break. I don't want to presume to know which level, but I think it's much more geopolitics. Is an import nation, what it means to Australia up through the Pacific Rim, what it means for China obviously is front and center.
Elisa, they're getting squeezed.
Yeah, and this is definitely the issue. You know, Paul Krugman put out a tweet that the media seems to be reaching peak inflation hysteria at the very moment. Early indications suggesting that inflation are not necessarily exponentially increasing. That said, it is this squeeze that really we're talking about, right? And I think that that is what we're focused on. How is this going to affect what we're going to see ahead of time? This just distracted me because I saw this and I was thinking to myself, what does that mean,
well,
peak inflation hysteria?
Do you know, my frustration with this, there are some great minds in economics, but when they become political hacks, what's the value in some of that coverage anymore? Did he forecast where inflation would be? Didn't he call it hysteria last year, essentially? Come on.
But this goes to your point about what hyperinflation is, right? And I don't think that it's fair to say anytime we're talking about inflation and the pickup, we're talking about hyperinflation, which you very well stated. That is not what we're talking about. It's not the runaway or unmoored kind of inflation. It's an inflation that squeezes particularly the lower class and that frankly changes the view for an economy that has become accustomed to a very low interest rate.
What a surprise. The front pages of the newspapers upset someone because it goes against their politics. I mean, ask anyone in America right now how they're doing in the low-income groups and ask them if it's hysteria. It's just a ridiculous statement to make. Equity futures down 0.4%. Dollar yen pushing 134, 133.99. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. The OECD says the world will pay a hefty price for the war in Ukraine. The organization slashed its outlook for global growth this year from 4.5% to 3%, and it doubled its inflation forecast to nearly 9% for its 38 member countries. Now, Credit Suisse is considering a round of job cuts after warning of a second quarter loss. Bloomberg has learned the cuts would be spread across divisions, including investment banking and wealth management. It was Credit Suisse's sixth profit warning in the last 7 quarters. In LA, a billionaire developer will take on a veteran politician in the race for mayor. Rick Caruso will face Congresswoman Karen Bass in November. Caruso won 41% of the votes in yesterday's primary, while Bass won 38%. Both are Democrats, although Caruso is a former Republican who did not switch parties until January. Chris Crispin Odey has recouped years of losses at his hedge fund. Last year, the Odey European hedge fund made 14%, boosting returns for the year to 110%. Combined with the 54% increase last year, the fund is now above the level set in 2015. That marks a full recovery and allows it to change incentive fees. Odey's bearish bets during a protracted bull market of stocks led to a 68% plunge. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
We stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
the Fed has to worry about is the fact that the domestically generated inflation is so high, and that's coming from a tight labour market. Now, from that perspective, what they need to do is slow the economy, and they need to gently raise unemployment. But we all know what a double-edged sword that is.
David Page there of AXA Investment Managers from New York City this morning. Good morning to you. Futures down 0.4% on the S&P, on the Nasdaq 100 down by 1/3%. Yields just a little bit higher, up 4 basis points to 3.01%. Look out 135 on a German 10-year bund. We'll talk about that in the next hour. In the FX market, euro dollar 107.28 and dollar yen pushing 134. Tom, I know that's got you excited through this morning.
It does. 2 housekeeping notes here. First of all, on David Page being on yesterday talking to Farrell off mic, folks, about English football. David Blanchflower of Dartmouth is scheduled to be with us today on Cardiff and Gareth.
And the labour market, Tom, and the Fed.
Oh, yeah, that as well.
That's going
we'll
to be
do that as well.
Maybe up top. 134 handle right now on dollar yen. Can I squeeze this in just quickly, Tom?
Please.
Just want to get to Credit Suisse. Forgive the snark. Just allow me just a couple of minutes of it. Just a couple of minutes. Yesterday, we put out a story on the Bloomberg with an interview with a guy called David Miller. He's the global head of investment banking and capital markets over at Credit Suisse. And this was his quote. I've been using the entire 5 months, the first 5 months of this year, running around seeing clients and telling them we're back. 24 hours later, Tom, the headline from Credit Suisse, it's another cut to the profit outlook for this name.
It has been a process,
Third straight quarterly loss.
For those that don't keep up with this soap opera, this is not a 5-year deal. This is a 10, 15, 20-year cultural phenomenon. John, I want to go to what you and Lisa were arguing about with Professor Krugman, and this is inflation, and this folds into Terrence Haynes, founder of Pangea Policy, who gets it. What you do, folks, is you set up a moving average wrapped around the culture of whatever the series is. Here's the math, Terry Haynes. The moving average of a gallon of gas is the monthly bill people face. You bring this down to the rent, to the gallon of gas, to paying the bills on whatever the day of the month is. Brent crude, 30-day moving average, $113. It was $110 peak in April. We've breached through to a new monthly high on the cost of oil. Terry Haynes, how does that play for Republicans moving to November?
Well, politically, it's very good news for Republicans, and it's very bad news for Democrats. I think that's obvious. And off that, what you have is Secretary Yellen saying yesterday that really Congress could do a lot, kind of passing the buck there, very similar to the way that President Biden passed the buck to Fed Chair Powell last week. So, what you've got is you've got an administration that wants everybody else to do the work, is not stepping up to provide a kind of a suite of solutions to really hit it. And and so the politics, as you ask me, is not going to move any off of that.
Okay, but you're reading my mind, Terry Haynes. My question is, where's the energy czar for the Biden administration? We're all very czar-like whenever we are in these crises. Where's the energy czar?
The energy czar, I think, is going home at Friday at 5 and coming back Monday morning at 9. Frankly, I have one simple test for whether there's a crisis in Washington, and it's if people stay the weekend to work. And I've been through a few where we worked for 40 days straight, like USA Patriot and all the rest. But when you have a situation where everybody from the president on down is essentially checking out for the weekend, what you have is Washington telling you that things are going to operate as normal and are not going to operate on a crisis level.
Terry, this is really important. Are you basically saying that Jennifer Granholm isn't taking this seriously enough, and that this administration is basically being caught staring into the headlights and not really prepared to understand the scope of what these gas prices and what this inflationary outlook really means?
I'm sure Secretary Granholm is taking this seriously. I'm sure that many in the administration understand very well what the issues are, what the economic stakes are, what the political stakes are. All I'm suggesting is that it's easy to tell whether people are concerned about a problem versus whether they're interested in solving it. And right now I see a Washington generally that is not interested in solving any of this stuff.
Washington being the Democrats and Republicans, just the Democrats. Do the Republicans have a plan?
I don't see the Republicans as having a particular plan either. But, you know, I look at, you know, things going back to, say, Theodore Roosevelt's bully pulpit. You know, I don't see an ability or a desire, frankly, from anybody. And, you know, the president's a Democrat. Democrats are nominally in charge. So, you know, a little bit more of this falls on them, you know, to really drive it and either try to solve problems in a bipartisan way, really reaching across the aisle, really being aggressive, energetic, all the rest. Or on the other hand, you know, politically, frankly, the Democrats trying to put the Republicans on the back foot. I don't see either of that happen.
Terry, we've heard from several reports that the president is frustrated with the strategy in the White House, the approach, the messaging, what they've allowed him to do, what they've stopped him from doing. Terry, why haven't we heard more about changes, personnel changes?
That's interesting, isn't it? I'll tell you my own view on this, which is, you know, a little bit of observation, a little bit of understanding, and a little bit of a whole lot of experience, frankly, is very simply that what you've got is, you know, the president made his deal with the progressive wing of his party at the very beginning of this. It is now not going so well. You know, the advisors that brought him to this juncture and that he let bring to this juncture, frankly, are people that are more interested in continuing their relationship with the progressive wing of the party than they are about getting the president to be, you know, more centrist, reaching across the aisle. One thing I saw this week that was very interesting, and, you know, there were a lot of elections this week and whatnot, is, you know, you see the I'm on your air all the time talking about 4 factions, not 2 political parties in Washington. What you saw this weekend or seeing is kind of the strike back of the centrists, people that want common sense solutions, people that want problems to be solved, whether that are politicians that advanced in primaries yesterday.
Okay, Terry.
Frankly, somebody like Matthew McConaughey was in here asking for common sense gun solutions.
But Terry, who is the Democrats' new mayor Daley of Chicago? Who's going to pick up the trash?
Wow. You know, that one of the biggest problems for the Democratic Party is that there's a very short bench, and there isn't an obvious solution to that. You know, in Chicago 40 years ago, the ship righted pretty quickly after Jane Byrne went off the rails, and we went back to Richie Daley and the kind of more you know, Daley-like model. That's gone off the rails again in Chicago. It's been righted to some extent in New York. It's clearly off the rails in San Francisco and Los Angeles.
Yeah.
But there aren't obvious solutions to that. But you've got a lot of centrists and a lot of insurgents trying to trying to push back on
Terry,
all of that.
There's a lot of work to do.
So we'll see.
And so little time. I've got 5 seconds left. Terry Haynes, thank you, of Pangea Policy from New York City. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This may be the first quarter that we start to see a noticeable hit to profit margins.
Margin is at risk of further compression, and earnings expectation for this year is perhaps too rosy.
What we have here is the consumers reposition very quickly.
Lower income households are going to have a harder time, and we are going to see some pulling back.
What these companies are doing is acknowledging that there is weakness ahead.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down about 1/3%. TK, the week begins tomorrow.
The week begins tomorrow, and then into CPI Friday as well. And what you've got is dynamics setting it up. You've got a lot of movements, John, and the tea leaves across a Bloomberg terminal. Moments ago, yen weaker, a 134 print.
Dollar yen 134 and a BOJ, Tom, increasingly isolated. This cycle, this tightening cycle of this Fed is different to the last one. The ECB sat out the last one. It won't be sitting out this one. Can the BOJ do the same thing again?
And what I would say, John, is it's not in isolation. I don't have the work in front of me, but the convexity of German 10-year, I'm absolutely fascinated how the various blocks at ECB, as Lagarde speaks, what do they do with the acceleration of a higher German nominal yield?
German 10-year right now, just short of 135 at 133. Lisa, the growth outlook isn't getting better, it's getting worse. You heard from the World Bank yesterday, we heard from the OECD about 30 minutes ago.
Which is one reason why people think that perhaps the ECB will get a little bit of relief in terms of how much pressure they'll have to raise rates. However, there was that economic growth picture out of the Euro region and the economy there for the first quarter, and it was actually better than expected. So fuzzy data. How much are we looking at the Fed and the ECB hiking until something breaks, as Brian Weinstein was saying? And what does that look like?
What does it take to break something in the European economy, in the European debt market? Italy has got to be the one to watch. The Italian 10-year, the whole of the Italian bond market, can they take a whole rate hiking cycle from this ECB. Have you seen some of the numbers out there? Some of the estimates, Lisa, anywhere from 150 basis points, 200 basis points plus.
Are you surprised that we haven't seen something break more materially already in that market? Remember when people were saying that it was unlikely that we would ever see a move away from negative yielding debt simply because we have so much of it and it was the normalcy? We have shifted so dramatically and things haven't necessarily completely broken. How surprising is that? To me, it actually comes as a surprise. And how much further can they go probably depends also on how much economic momentum there is.
If you'd asked me 2 years ago, can the ECB hike interest rates in the next cycle, I would have said in the last one they didn't, and I imagine, Tom, they won't be able to this time either. This story's changed really quickly in the last couple of years.
There's a huge complexity going on. Of course, all of it centered around massive uncertainty on the war and, frankly, on food prices. And, you know, wheat, corn today elevated for the first time in ages. Wheat actually with a bid as well. But, John, what's so important here is not to be inflammatory about the observation of yen or what's going on with the German 10-year, and just to say these are instabilities, and, you know, to begin a theme as we go to Anastasia here after the brief, to begin with, it's overcome by events July, John. I think that's a new theme for me.
Looking ahead to next month, Tom, let's whip through the price action. We're down about 0.4% on the S&P, on the Nasdaq 100, down 0.25%. Yield's just a bit higher, up 3 basis points, 3% on a US 10-year. Crude at 120, Lisa, up 1% on the session, and Goldman says a lot more still to come.
And how much will that really bleed into the picture for inflation and consumer strength, particularly in the United States? The week does start tomorrow and into Friday with that CPI report. Today, President Biden is heading to Los Angeles for the ninth summit of the Americas. Cuba, Venezuela, Nicaragua, all not invited. The key issue for me is how much are we going to talk about nearshoring, bringing some of the manufacturing production in Asia closer to home for the United States in order to get ahead of some of the disruptions that we've been seeing throughout the pandemic and in this current period. Today, Bloomberg Tech Summit is taking place in San Francisco, virtually as well as in person. We've got the CEOs of Uber, Expedia, MasterCard. I know that Tom is watching this very closely. He wants to know what to do with his triple leveraged all cash fund and whether there still is some growth in profits for the tech sector. And today, Russian Foreign Minister Sergei Lavrov is heading to Turkey for talks on unblocking Ukraine's grain exports. This is key. In the Black Sea, where about 90% of all grain, 98% of all grain from Ukraine typically has been exported. It has been blocked by Russia. People have been accusing Russia of holding this area hostage and for the world's food supply. How much are they really going to come to the table to negotiate, given the fact that Vladimir Putin has come out basically and said that the U.S. has to remove sanctions before they're willing to unblock some of these passages?
Yeah, but guys, what's great about this, and not to be inflammatory, I mean, it's Inflammatory Wednesday, but if Lavrov shows up at 17 lira to the dollar, does he leave when it's 18 lira to the dollar?
It's a good question, John. I'm going to pitch this over to you.
You're going to punt it back to me.
I'm going to punt that back to you. You can handle that one.
Thank you, Bramo.
Anytime.
Did you see the comments from Chancellor Merkel on Russia?
No, please.
Worried about isolating Putin.
She's been
This
quiet.
is a theme that I keep hearing about out of the European capitals. We're hearing it from the former Chancellor, Angela Merkel.
And
we heard
Macron.
it from Macron over the weekend too, Tom. Just something to watch.
I think that as General Kimmett briefed us with General Hodges, they were dead on. There's an actual war going on, John. I've said this in phone calls and meetings. You get this conversation where it's almost like pretend war were removed.
I hear you, Tom.
It's not.
It's real.
It's like real folks. It's not,
kind of fallen off the front page in a way.
Yeah, it's not like a Hollywood movie. It's
I hear
like
you, Tom.
really, really bad. Why don't you get to our esteemed guest who's attuned to this?
Who's not going to talk about dollar lira? Anastasia Amoroso, the Chief Investment Strategist at iCapital, joins us now. Anastasia, let's start here. You're looking for a soft-ish landing. Let's talk about the ish. Any evidence of that developing at the moment as you look at the incoming data?
Yeah, John, good to see you. I think there's a few things that I look at that give me a hope that we may actually have a wider path to a soft landing here. The first one is you look at the growth numbers. I mean, even with the OECD downgrading growth today, it's still a positive number. And if you look at the U.S., we're expecting 2.6% this year, 2% next year. This has not fallen off the cliff. It is still hanging in there. So yes, we're squarely in a slowdown part of this, but this doesn't yet have to be an imminent recession. You know, the second second thing that I look at, and frankly, I've not been able to say that, yes, we have seen peak inflation and yes, this is it. But now I feel like there is more and more evidence building that maybe we are starting to see peak inflation. I mean, look at used car prices. They're starting to decline. Look at the businesses' intentions to continue raises prices. They just can't do it anymore. So more and more of them are saying we're going to pause. If you look at businesses' intentions to raise wages, they're pausing as well. So there's starting to be sort of a preponderance of evidence that maybe inflation is in fact easing. And this is commodities notwithstanding, but the other inflationary pressures seem to be easing. And then the third thing, John, that really gives me some confidence that maybe we can engineer a soft landing is the Fed is starting to sound a little bit more balanced. Yes, of course, they need to fight inflation, but maybe it doesn't have to only be by raising rates well into tightening territory. You know, maybe they can pause and let the high prices naturally bring down demand. So I think if they back away just in time, we might end up with a 94 scenario versus the 70s.
Anastasia, everyone wants to game out where we're heading right now. What does that mean for what you're actually buying? Because you have to come up with a thesis before we have all of the dots of what the Fed will or won't do and how the data is going to come in. How risk on are you right now?
Yeah, so it's all about the balance of risks. And I would say just a month or so ago, it seems like we have priced in a lot. We were already at that point, the equity markets were pricing in a 57% probability of recession. And now we've retraced some of that. Where I am today is I think we're trapped in a range. I always thought that 3,900 for this economic environment could sort of be the level of support. We seem to have bounced off that level. But at the same time, how much are you going to pay for $235 worth of earnings? 16.5 times is fair, maybe 17.5 times is fair, which is roughly where we are today, 4,100 on the S&P. But how much more do you push that? So I think, you know, Tom, we are trapped in a range for now, but still there's some investment opportunities to look at. You know that I've liked technology, but one of the calls I have now is actually on financials.
Okay, you have it on financials, but part of this is the overarching theme, and that goes back to expect the unexpected. And I'm talking about overcome by events July. There's a mix of dynamics on the screen which are clearly out of sorts. What's the thing you're looking at for July that could be the unexpected?
Well, I think the big, I don't know if it's unexpected, Tom, but maybe it could still surprise us, is the commodity shock, right? Even though I'm saying the supply chain bottlenecks are easing and other inflationary pressures are easing, the commodity shortages are not going away.
I'm going to stop the show. You, more than anyone we know, have a visceral understanding of the coast of the Black Sea. You own the high ground on this. How do you respond to the idea that Odessa with one S or two S's could be shut down?
Look, this has a big implication for the commodity market. And, you know, as I mentioned, the world is short of everything. The world is short of wheat, the world is short of grains, the world is short of oil and natural gas. To the extent that you close off that corridor, to the extent that the tensions continue to escalate and you can't get product out of that region, that is really, really tough. I mean, I think that's what people perhaps don't fully price in and don't appreciate. Commodity prices are up a lot this year. And, you know, I think a lot of investors say, well, how much more do you chase that? But what people probably underappreciate is that we have a structural deficit of many of these commodities. So this is not just a tactical trade for this year, but this is longer lasting.
Such a good point. Anastasia, thank you. Anastasia Amoroso there of iCapital. And Tom, I think there's something that maybe wasn't consensus a year ago is quickly becoming so, and that was the view of Christian Malik of JP Morgan Investment Bank over in Europe, Tom, when he talked about the lack of spare capacity in OPEC at the start of the year, and that felt kind of out of consensus. I tell you what, it's quickly becoming consensus for a lot of houses.
And on a microeconomic basis, JP Morgan's done a lot of great work here and others as well. Amrita Sen has been really wonderful on it. John, we don't even understand that when it is a normal hydrocarbon market, the supply and the demand is wicked tight. That's CFA talk, John. Wicked tight. Equilibrium point.
That's CFA Boston, Tom.
Yeah, wicked tight.
Without a doubt. 121 Brent, 120 WTI. Crude inching higher by 0.9%.
500 ball, Red Sox.
From New York. Are they doing better, Tom?
They couldn't do worse.
This is Bloomberg.
Keep Keeping you up to date with news from around the world with the First Word News, I'm Leanne Guerin. So more problems for Credit Suisse. The Swiss lender has issued its sixth profit warning in 7 quarters. It expects a loss at the group-wide level and investment bank in the second quarter. Bloomberg has learned that Credit Suisse is considering a round of job cuts, part of a renewed push to cut costs. Here in the UK, Bloomberg understands that Boris Johnson will go ahead with the legislation to override parts of the Brexit deal. That risks inflaming tensions with members of his Conservative Party and with the European Union. The Prime Minister's government has been pushing to rewrite the Northern Ireland Protocol that keeps the region in the EU's single market while creating a customs border with the rest of the UK. The OECD says the world will pay a hefty price for the war in Ukraine. The organization slashed its outlook for global growth this year from 4.5% to 3%, and it doubled its inflation forecast to nearly 9% for its 38 member countries. In San Francisco, residents voted to recall progressive district attorney Chesa Boudin. Boudin tried to reform the criminal justice system, but critics accused him of being too soft on crime. About 60% of those voting in favor want to oust him. He will be replaced by an interim district attorney chosen by the mayor, London Breed. And the son of the founder of Walmart, Robert Walton, is leading a group that has agreed to buy the National Football League's Denver Broncos. ESPN reports that the Walton Group offered almost $4.7 billion. That would be the highest amount ever paid for a U.S. professional sports team. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts, great questions. June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
There's no question that we have huge inflation pressures, that inflation is really our top economic problem at this point, and that it's critical that we address it. So I do expect inflation to remain high, although I very much hope that it will be coming down now.
What did Paul Krugman say? Lisa, inflation hysteria of the media.
It's the media.
That was Secretary Yellen there of the Treasury. From New York City this morning, good morning. Futures negative on the S&P, down 0.25%. On the Nasdaq 100, down about 1/10. Off session lows. Yields higher by 3 basis points through 3% on a US 10-year. Tom Crude, 120.56, up by about 1%.
At a 122 print on Brent crude right now, 121.60. John, I think we got to go back to first principles on Friday, which is a hugely important look at CPI, and say the top line CPI is grim, from 8.3 down to 8.2%, pretty much unched. But there's a demonstrable ebbing in core CPI. Maybe that will be the number to watch exactly at 8.
Month over month, Tom, without a doubt, for Wall Street, that's going to be the focus. For Main Street, it's everything else. And as you've said, Lisa said, I've said a million times, you can't eat or drink core CPI. And you certainly can't travel on it.
Let's get to a question that came up over dinner a couple nights ago. We can do this with Emily Wilkins in Washington. Emily, taxes vary state to state. Why are we waiting and taking a tax holiday?
I mean, a couple states, they are debating this in terms of taking a tax holiday from potential gas prices. But at the federal level, the main concern from Speaker Nancy Pelosi has really articulated this, is that if they were to take a holiday, it doesn't necessarily mean that these oil and gas companies are going to pass the profits down to the consumers. And there's additional concern that, you know, these taxes are used to help fund highways. We just passed that major infrastructure bill, and they want to make sure that there is funding there.
Dumb question of the morning. It goes to you, Emily Wilkins. Do the Democrats support, and frankly the Republicans, do they support our president traveling to Riyadh?
I mean, there definitely is some debate about exactly what Biden should be doing, how he should be engaging with the government there. I think it's one of those things where it's just the real politic is dominating the moment. The fact that everyone knows that gas prices are a high concern, trying to figure out what they can do. I mean, you've seen the Biden administration try to tap into the strategic reserve. You've seen Democrats kind of rail against various companies. You've seen measures tried to be moved, and yet you haven't seen much of a change in that price. And so I think there is a reality here that this is a global issue and that Biden will need to have global interactions to address it.
Is inflation really the center of gravity already in Washington, D.C.? We know it is outside of Washington, D.C. when you go and you talk to anybody or you go drive around. But it feels very kind of disparate in terms of the messages that we're getting from President Biden, who's currently heading to Los Angeles for a summit with North American partners.
I think that's because the White House has taken so many different messages as to explain inflation. They've tried to blame it on Putin. They've tried to blame it on the war in Ukraine. They've tried to blame it on major corporations. They've tried to blame it on the pandemic. And I'm not saying that there isn't truth in various pieces of that. But as far as one clear and consistent message, we've seen that more from Republicans who have simply been blaming Biden for it. And I think in D.C., one thing that lawmakers always like to say here is that they can walk and chew gum. There are multiple things going on at this point that are really dividing everyone's attention. Certainly, the gun debate is front and center in Congress this week. You mentioned that, Biden is looking at this conference of the Americas. That's certainly another thing on his plate as well. There's inflation to deal with. There's pricing. There's hopes that they can wind up passing something through reconciliation. So just a lot that is happening right now, and there isn't exactly one straight focus here in D.C.
Emily, for our international audience, and folks, we haven't done this too much international because in America, America on cable TV, the gun debate is 24/7. There's no question about that. What is the distinction right now of the quote-unquote gun debate, Ms. Wilkins?
Well, at this point, all eyes are on the Senate, where negotiations are happening between Democrat Chris Murphy and Republican John Cornyn. And Cornyn's really the linchpin on this, because we all know there are many Republicans out there who would be perfectly fine keeping the status quo as is. But, you know, Cornyn's from Texas. He has that connection to Uvalde, and he is trying to get something through.
Emily, what are they going to do to stop the X number of people who will be killed between now and 6 a.m. Monday morning? Is there anything in the legislation to give hope to that concept?
The one thing that they really seem to be pushing right now, that gun advocates as well have been urging for, are these so-called red flag laws, this temporary removal of guns from those who have deemed danger to themselves or others. But at this point, there doesn't even seem to be a federal law in the works. What it seems is that the federal government is going to try to encourage states to take up these own laws through a grant program. And we've seen more than a dozen states take up these laws already, including in some places like Florida, some of these red states. But at this point, that really seems to be as much as they want to do in terms of gun control. We're expecting to see some more on mental health, some more on school safety. But really, at this point, it is still a very, very difficult issue, even given how heartbreaking and tragic some of the recent mass shootings have been.
Emily Wilkins, thank you, down in D.C. Lisa, on several fronts, you hope that we can achieve something on the policy front. Going into the midterms, it just feels like we probably won't.
I see no policy prescription right now on the table. There's a blame game, a massive blame game, with people saying it's somebody else's fault on all sides. Perhaps the Republicans are getting more traction with it because it's a cleaner message than the Democrats, and that's simply what you're getting. Beyond that, what are we looking for in terms of a Democrat or Republican win, and what the policy implications of that will be? That also not very clear to me.
Something to focus on through the next several months going into the back end of this year. Let's start here with the equity market. We're down about 1/3 on the S&P, on the NASDAQ 100, down about 0.1%. No real drama in the equity market this morning, at least. It's a quiet morning. In the bond market, too, to some degree. Yields higher by 3 basis points. But in foreign exchange, Tom, we just keep going back to it. I know actually at the moment it's the first thing you look at. It's dollar yen, the first thing you look at in the morning, through 134 briefly earlier this morning.
You look at Euro-Yen complex, Aussie Yen is frankly just as important with our American centricity. But I also look at a lot of the other pairs, John, in the blended indices. The fact is DXY and the Bloomberg Dollar Index, which is better math, the fact is they really haven't broken out to new dollar strength. And that's a raging debate among currency pros.
Tom, looking forward to a conversation coming up with Bob Miller of BlackRock. We'll do that in just a moment. Lisa, we've got a lot to talk about in this bond market with yields breaking out over the last couple of weeks.
Yeah, although stasis right now. Are people basically believing that the Fed is going to move just enough? Is basically the idea of a soft landing or a soft-ish landing now becoming more on the page? How much is peak recession fears kind of a little bit past us?
Futures negative 0.25% on the S&P, on the NASDAQ 100 down 0.1%. On that particular conversation, Lisa, I could probably run with that. This idea that maybe we've seen this mechanical peak, which is the point that Paul Krugman was trying to make a little bit earlier.
Inflation still the main problem facing the U.S. economy. Janet Yellen's words, not mine.
Without a doubt. Yields higher by 3 or 4 basis points, 3.01% on a 10-year. From New York, this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
No drama this morning. Good morning. No drama, at least so far. Equity futures down 0.25% off the lows on the S&P. On the Nasdaq 100, down by about 0.1%. The OECD cutting their outlook to about 3% for global growth. That's not news, is it? That's confirming what we've already heard from a lot of other places, including the World Bank yesterday, looking for 2.9%. That's the equity market. Here's the bond market worldwide. I want to talk about this. Easy to spot the difference here, isn't it? Which one is the odd one out? Looking at the US 10-year, the German 10-year, and the Japanese 10-year. Yields up in the US, yields higher over in Germany, 135 on a 10-year bund, and almost totally unchanged at 25 basis points in Japan. The why? Because the BOJ is trying to cap it there. And as they do that, as they try and cap bond yields at 25 basis points, remain committed to not hiking interest rates, whilst the latter two central banks, the ECB and the Federal Reserve, look at making a continued move through the rest of this year. This is what happens through the FX market. You push this through foreign exchange, the Japanese yen has to take all the pain. Dollar yen breaking out again, 135, Tom, on dollar yen in sight, after briefly breaking 134.
It's a lot of dynamics there, and we'll be looking at that in the course of the coverage of the ECB tomorrow. It will, I'm sorry, John, it's all of a sudden ever huger deal with frankly Pacific Rim ramifications.
I had someone message me this morning about the ECB, Bramo, and they basically just said, are you serious? I cannot believe they're not hiking tomorrow. What's this about? Laying the groundwork for future meetings. Let's go.
We were talking about this in the break. Why not, right? Why not just raise 25 basis points? Forget 50 basis points. Just get ahead of it. If you're going to talk about doing something and the need to do something, what is holding them back? And you pointed out that it was the peripheral yield market, that they're concerned about disrupting Italy, as well as Spain and Portugal and Greece. I mean, all the other countries. How much can they continue to do this? Because at some point, they've got to rock the boat to get some sort of tightening that is required for the inflation that they currently have.
Trying to hold the market's hand in a way the Fed is not. Key difference, though, the labour market in the US stronger than the labour market in Europe, maybe allowing them, Lisa, just to go a little bit harder here in the States.
Yes, although they have to do something. So when does hand-holding become counterproductive and actually go against the end goal? How do they get around that? What other policy prescriptions, supportive perhaps for the Italian, the Portuguese, the Spanish, the Greek bond markets, could they come out with?
Do you remember when President Lagarde said she wasn't there to close spreads?
You loved that. You just nailed on that. You were like,
no, just
next day.
We're here to close spreads. Was it even the next day?
We're here to close spreads.
I think it was hours later.
Yes.
Let's make a quick interview with someone we like so they're kind to us and we get to say what we want to say. talk about that another time. That's your cross-asset price action. Let's get you some single names, some stock movers. We can do that with Romain. Morning, Romain.
Hey, good morning, John. Of course, back here in the U.S., all eyes still focused in on consumer spending. We did get Campbell's Soup earnings just a little bit earlier this morning here. They were actually pretty good, at least on the overall numbers, but it was an interesting mix here. Total sales were up about 7 to 9%, depending on the category. However, you actually saw a decline in the volume of sales here. Now, Campbell made up for that with a 3% decline in volume across the board. They made up for that with roughly about a 10 to 12% increase in prices. So an interesting mix here of a company that does, at least for now, showing a little bit of pricing power, though is also making clear that, at least on a volume basis, things have tamped down a little bit. Nevertheless, Campbell shares up about 5% here in the pre-market. Meanwhile, also in the consumer space, you have Affirm. Those shares down about 4% in the pre-market, and we know they got battered around on Monday because of that entry of Apple into the buy now, pay later space. But there's a broader issue going on with Affirm, and it's highlighted in a wonderful Bloomberg story today about some of the securitizations that Affirm has issued, where it repackages those loans, and the prices of those, of the existing ones, have started to fall. And of course, any new issuance that this company comes to the table with, they're having to pay more, basically offer a little bit more yield. This is a big concern now. Remember, the business model for Affirm is way different from the other buy now, pay later companies that actually finance themselves primarily through debt or customer deposits. So keep an eye on that space. Remember, this is a stock already down 70% from its all-time high. And then there is still a focus on business spending. Smartsheet came out with earnings. This is a big software company. They beat on a lot of the top line numbers, but there was a deceleration in growth that had some folks concerned. Those shares down 6%. And then we heard from Intel the other day, a lot of the company's management, they were at a conference there, and according to Citi analysts, they said the mood was actually pretty dour. They were talking about a lot of challenges ahead. Intel shares down about 3%. Meanwhile, DocuSign, a big pandemic darling, they're actually reaffirming their partnership that they've had with Microsoft. That's giving them a little bit of a lift. DocuSign shares up about 5% on the day. And, well, the pandemic is sort of over, but Novavax finally getting its vaccine potentially to the U.S. market. An FDA advisory panel yesterday, Tom, did finally sign off on that. They still need full FDA approval, but those shares up 10% here in the pre-market.
Roy Bostic, thank you so much. The close coming up this afternoon as well. This is the conversation today. If you've opened up the proverbial envelope and looked at your bond portfolio and said, ooh, price down, yield up. Bob Miller, head of America's fundamental fixed income at BlackRock, has decades of experience at looking at that. He's younger than me. Long ago, he was with the Davidson Wildcats getting things done, and I was enjoying the last time we had a bond market like this, which was 78, 79 Volcker. Bob, what do you do to claw back to 2025? What is the attitude you take where you're down 10%, 13%, 16%, 4 years coupon, and I got to claw back out 3 years? What's the strategy?
Great question, Tom. You know, the interesting thing is there is some value that's starting to be created in the U.S. fixed income market. Let's just stay there for the time being.
Please.
You know, at wider spreads recently, some of the spread products, you know, whether it's securitized CMBS, CLO, et cetera, or even high yield and the you know, triple B IG stuff started to look reasonable. Now, spreads snapped in pretty aggressively in the last couple of weeks. I wouldn't be surprised if we get another bite at the apple. But at these forward rates in treasuries, you know, we think rates probably go a bit higher. Specifically out in the term structure of rates probably goes a bit higher. But we're starting to get to levels where you can build a portfolio that probably earns, you know, 3 to 4, maybe even 5% in a certain scenario over the next couple of years.
Of the Frank Fabozzi,
so it's plausible to get it back.
Of the Frank Fabozzi variables, can you extend duration? That seems to be the biggest risk right now.
So that's a tricky one, right? I think the consensus view is yes, that for a reason that I agree with, which is treasuries now do have some portfolio hedge capabilities or properties, which they didn't have a year ago or 2 years ago because the levels were so low, the yield levels were so low. So yes, in an absolute crisis, treasuries are going to rally a lot from these valuations. But I'm in the camp that thinks there are a number of longer term, more secular perhaps influences that are likely going to work to push the term structure of rates a bit higher over the next couple of years. Things like all of the 2 of the 3 G3 central banks abandoning QE and the Fed now starting to allow runoff. Things like Europe pursuing energy and security independence will require a tremendous amount of investment/borrowing. If the world actually does become genuinely motivated to pursue net zero, that's going to require a massive CapEx program around the world over a couple of decades. That will likely lead to a higher term structure of rates. So there are a number of things that kind of lean in that direction. They're not near-term catalysts at all. But I think the term structure could probably, I think we could have a steeper curve for the same level of inflation and same level of growth over the next couple of years.
Bob, early this year, people looked every morning at the Fed funds futures and when the Fed would raise rates, what the things were gamed out, how much rate fear was there currently in the market. We've shifted. Now people are looking at economic indicators, and it's less about the Fed parlor game, as Tom likes to say, but more about the fundamentals, some of the secular changes that you're talking about, as well as whether the U.S. economy is accelerating or actually experiencing certain stagflationary types of dynamics. What do you look at every morning when you come out with a near-term and a mid-term view of those yields?
So, Lisa, the tricky thing is that financial conditions in the U.S. have tightened a fair amount. The impulse, the magnitude of tightening from very accommodative levels is sizable on a historical basis. So it's possible that FCI, that financial conditions, have tightened enough to allow the Fed to achieve its target with respect to inflation. The challenge is you actually have to deliver the forwards in order to get that tightening, right? So or it has to come through other channels that are less favorable. So the forwards, as you said, are priced for very specifically for 350s and 225s over the next 5 meetings. I think that's probably sufficient, and we're also priced for a 3.25 terminal rate a year from now. That may well be sufficient. It's just that you've actually got to deliver that in order to get there. So the vol in the U.S. has started to come down, and that's probably a durable trend. It's not going to collapse, but realized and implied volatility has started to come down because we've kind of settled into, as you said at the beginning or when we were talking before the show, we've settled into a little bit of fatigue with respect to the Fed, and the forwards seem pretty fairly priced for what we know today.
It's the part of the conversation we should take live to air. Just Lisa in the commercial break telling the world what she really thinks about everything. If you thought the stuff on air was punchy, the stuff in the commercial break is so much better. Bob Miller, thank you, sir, of BlackRock. I caught up with Rick Reader of BlackRock on Friday, and something he said has just stayed with me over the weekend and into this week as well. Just turned around off the back of the payrolls report and just said, John, that's the last strong one. I think that's the last strong one. And Tom, perhaps a negative print is in our near future. That was the take from Rick Reader over BlackRock.
This bet is out there. And let me say, John, I have an immense respect for people in equities and bonds that actually have to run money. There was way more discussion of the bond bear market at the end of the 70s into Volcker than there is now. There's like this secret, this is just going to go away somehow. Totally. And the fact is, I'm looking on the Bloomberg at R squared's way above 0.90, sharp ratios that are unmeasurable, and I'm sorry, double-digit losses in bonds with coupons of 4%. And we're not talking about it.
Tom, that sentiment that it's just going to go away, I think that extends to so many things at the moment.
Yeah.
I think a lot of people would watch this program and say, oh, it's so gloomy. Most of the guests still believe the Fed backs away by the end of the year.
Oh, yeah, okay. Mrs. Keene was hoping I would just go away.
Is she still hoping?
She's still
Will she
hoping.
get her way?
She's
got to stick with this one, Tom.
Let's
make this one work. Futures down 0.6%. This is Bloomberg.
At least my sweatshirt's fit.
True.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Credit Suisse is considering a round of job cuts after warning of a second quarter loss. Bloomberg has learnt the cuts would be spread across divisions, including investment banking and wealth management. It was Credit Suisse's 6th profit warning in the last 7 quarters. Over in LA, a billionaire developer will take on a veteran politician in the race for mayor. Rick Caruso will face Congresswoman Karen Bass in November. Caruso won won 41% of the votes in yesterday's primary, while Bass won 38%. Both are Democrats, although Caruso is a former Republican who did not switch parties until January. Western Digital has announced a strategic review that could result in the separation of its two businesses. The announcement came after weeks of talks with activist investor Elliott Investment Management and other shareholders. Western Digital is one of the world's largest makers of a type of chip called flash memory. It also makes hard disk drives. Shares of Novavax are soaring in pre-market trading. The company's coronavirus vaccine has won approval from a U.S. Food and Drug Administration advisory panel. Analysts say that it is good for the shot's chances of gaining emergency use authorization. And do you know what the most expensive city in the world to live in as an expat is? So for the second year in a row, that is Hong Kong. Now that's according to the ECA International. Higher prices and a stronger currency kept the city at the top. New York, Geneva, London and Tokyo round out the top 5. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
oil prices move away from where they've been for a while, when they get salient in household decisions, when they really get your attention, that's when they matter for economic activity. And guess what? We're long past that point. Yeah. It is number one concern among households. It's got to be crimping household spending.
We're a long way past that point. Vincent Reinhardt there, the chief economist at Dreyfus and Mellon. He was fantastic, Tom. With Tom Keane, Lisa Brammett and Jonathan Ferro, this is Bloomberg Surveillance. Your equity market looks like this. We're negative on the S&P just a bit, down 0.2%. On the Nasdaq, a little less. We're down 0.1%. Yields higher by 3 or 4 basis points, back through 3%, 3.01%. Crude, WTI, with a 120 handle. 120, spot 63, up more than 1% on the session. Year to date, up 60% on WTI, on Brent up 56.5. Citigroup making some adjustments coming into a brand new trading week, Tom. Over the weekend into Monday, they raised their second quarter Brent crude forecast by $14 to 113, their third quarter estimate by 12 to 99, and their fourth quarter forecast by $12 to 85. That 4Q, Tom, compare the 85 at Citi to where Goldman are at. That is a wide spread still between the two.
This is the privilege that we have, not only working with Javier Blas, Will Kennedy, and all of Bloomberg hydrocarbons and commodity coverage, but also digging deep into the analysis of global thinkers. The giant of all this is Edward Morse with Daniel Yergin, separate, looking at the global macro moment of this commodity boom. He is global head of commodities at Citigroup, and as John says, has a bit of an outlier call right now. Ed Morse, how do we migrate back to your oil fundamentals under $90 a barrel? What are the trigger points or catalysts that break the ascent of oil?
So the catalysts really are very simple. They're called supply and demand, and we've got to get through the next few weeks to see whether there actually is going to be a driving season this summer. But underlying the differences of view is really what we think is raising prices now. And what we think are raising prices now are the dislocations that have occurred as a result of countries and companies refusing to take on Russian oil. There's no easy substitute for euros. We're not in a one oil pricing system. We're in a two oil pricing system. And we have to remember that while WTI may be at 120 or Brent may be at 120 something, Urals is trading at 30% lower than that. So it's not one clear market, and it's the disruption of that lower price that we have to think about and ask why we have these higher prices.
And I'm going to just say that we're planning a trip, Lisa, John, and I, to Abu Dhabi. And of course, we're going to have an oil summit there. And we're going to have on stage Francisco Blanch, Christian Malik of JP Morgan, Blanch of Bank of America, you and other worthies. And the singular distinction seems to be the guess that hydrocarbon investment will or will not come on. If we get higher oil prices, are you more optimistic than others that investment will materialize?
Well, I think for starters, I don't think there's that problem. I think we have more than enough investment in hydrocarbons. I think we have a problem in the hydrocarbon world in that the United States, the short cycle big guy, has lost a lot of oil production. The U.S. was producing, we have to remember, 13 million barrels a day in March of 2020. It went down to 10.2 million a day. It's now at 11.9 million a day. It's well below where it was and where it would have been had we not had that drop in drilling. We would have been at 14.5 million barrels a day, and there would not be this problem. We have more than enough spending into oil and gas finding and development. It's shifted a little bit, but if we look at the next 2 or 3 years and compare expectations of demand and supply, we think the market is oversupplied.
Ed, have you seen any signs that demand is starting to cool for driving, for flying, that gives you confidence that perhaps we might not see the driving season that some people are expecting?
Well, we actually we're trying to observe that, and we've decided to look at not only the 4-week average at this time of year for gasoline and diesel demand in the United States, and we went back and discovered at first glance that it was the lowest it's been in 5 years, other than in that big year of 2020 when demand collapsed completely. We've now gone back 10 years to find a time when demand for gasoline and diesel were as low as it is, and we had to go back to 2012, 2013. So if we think the EIA weekly data have a semblance of reality to it, gasoline demand is down year on year, diesel demand is down year on year, and it's the lowest it's been for a decade. And that's a sign that the price of oil has had an impact on where demand is going in what still is the biggest oil-consuming country in the world.
So, Ed, why did you end up shifting your expectations, your forecasts higher, if you still hold to that conviction that we might not see the driving season that a lot of people are saying we will?
Well, we drove prices higher, first of all, to mark to market. We had second quarter results that are marking it to market higher than where we were at. And we tried to figure out what was really happening. What was really happening was that companies and countries were forswearing Russian crude. They could find no substitute for it. So they had to bid up the availability of light sweet crude in the world that is not the same as Urals. They bid it up from the country that has the most amount of this, namely the U.S. with our open borders. And the fact of the matter is that U.S. exports have been booming. Our combined exports of crude oil and petroleum products in recent weeks have been at the 10.5 million barrel a day range. That would make the U.S. the largest liquids provider in the world, bigger than Russia, bigger than Saudi Arabia. That's up by a couple of million barrels a day from where we were. So when companies had to look away from Russia for diesel, where did they go? They went to the U.S. When companies had to look for crude oil, where did they go? They came to the U.S. And our inventories came down, giving a misleading impression that the whole world was going down in the inventory side the same way the U.S. is.
Just quickly, and I've only got a minute, and this deserves a much longer conversation, of course. How sustainable do you think that is politically? Because I don't think those numbers are that well known outside of conversations like this one.
Well, I agree with you. If it became political, people would start talking about stopping the exports, just as they talked about stopping the exports of natural gas. But it could be politicized in a way that it would be in an election year, with gasoline prices being as important as they are.
Ed Morse, thank you, sir, as always, of Citigroup. Refreshing just to have someone say, we're market to market. Lisa, that's what we had to do. And looking at the spread through 4Q, and I think that's where the debate lies now, the difference between Citi and, say, Goldman. Citi at 85 in the fourth quarter on Brent. Tom, Goldman at 130.
These are huge decisions, and they're said with respect. We don't have an opinion on this, John, but I really can't say enough about in their lengthy reports, 20 pages, 40 pages, indeed 100 pages. They lay out a theory underlined by supply and demand, and that's the heart of the matter, is Marshallian supply and demand of oil. That's been the battle from day one.
And Tom, what did you make of those crude product export numbers that Ed just went through?
Ed is talking about the success of the American Energy Project. I was with Spencer Abraham the day the energy policy of America went down in flames. With that energy policy, lack thereof, we have a huge export market, particularly of distillates.
How politicized does that get as the year progresses? Right now, futures down a third on the S&P, on the NASDAQ 100 down a quarter of 1%.
Where are we going to be in 6 months?
$6 gas, according to JP Morgan, maybe at the end of the summer, Tom. Unreal numbers out there at the moment. From New York City, this is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a third dose is a must. for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think the Fed has a lot of catch-up to play.
Ultimately, what the Fed is trying to do here is achieve that elusive soft landing.
It does seem like the odds of a soft landing are reasonably good.
The risk, obviously, here is inflation.
Our view at the moment is that we avoid recession, but that probably means that the Fed stops much sooner than markets thinking.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television on Wednesday before Friday CPI. But we got to get there first. And tomorrow, John, ECB with some tough decisions given what Italian paper is telling us.
Without a doubt, Tom, they've got to clarify the road ahead, the path ahead through the rest of 22 and perhaps into 23, laying the groundwork for something we haven't seen from an ECB since 2011. Tom, an interest rate hike just around the corner.
It's around the corner, but I mean, it's definitely a road trip to Milan for the three of us. I mean, we've got to talk about what does the tea leaf of Italian paper mean away from what's going on with the German 10-year and the Japanese yen. John, what is the signal you take from Italian paper?
This is the signal I take from you. Why don't we just do a European tour? Let's go across the whole periphery. We'll go from Italy to Greece as well.
You thought you'd never ask.
Look, for me at the moment, the Fed's made a move, but the Fed made a move last time around on its own. The ECB didn't come along for the ride. The BOJ didn't come along for the ride. This is different. The ECB is going to come along for the ride. I have no idea how long that ride is going to last, but they're going to try. The BOJ, Tom, is trying to do something they did before. Wait, sit it out, and you're seeing what's happening in the FX market consequently.
We'll get to the data here in a moment. Weaker yen through the 134 print as well. That is earth-shaking. Let's keep this thing going, Lisa, on Italian paper, and it speaks to not full faith and credit, but the idea of the mix of the bond market. I'm sorry, it's price down, yield up.
Why isn't it yield further up for those Italian bond yields? Because the ECB has had the back of the peripheral markets for so long. How do they thread this needle? How do they support the areas that are most at risk while also allowing a tighter financial monetary policy at a time of such high inflation? They got to do something. And this is the shift in the dynamic right now, Tom. Central banks have a different calculus than they've had for the past decade or more. And this is going to be a very difficult period, which is the reason why people are pricing in so much higher yields.
In bank-to-bank there, Lisa, your view of Friday's CPI and particularly core CPI that Paul Krugman looks at?
I'm less interested in the headline numbers. I want to see underneath how much there is some sort of gains within the rental markets. I want to see what there is in terms of the gas component, what there is in disposable spending, in experiences. How much does the consumer start to pull back, and what that means for both inflation as well as growth?
John, the real yield solid. I know you're beginning planning for your Friday real yield show
with your team. It won't be a Friday, but someone else is planning, Tom.
It's not me, is it?
It's you.
No.
You're going to do it. CPI special, Friday, 1 p.m. Eastern. Everyone's excited now. I've called it. That's it. You're filling in. Yes, confirmed.
Tom's about
just
to
now.
walk off set.
1 p.m. Eastern time. Bloomberg real yield with TK. Following CPI.
No, my people have not.
The big look ahead.
This has not been cleared by
next week.
This has not been cleared by my scheduler, John. I'm going to start with 0.24%
Sure.
on the 10-year real yield. It's like a rock.
I'm going to pick up on what Lisa just said. There's a shift here from goods to services from the consumer. Target speaks to that story. Target has now got a bunch of inventory, all these goods that they've got to shout down. So what we could see is a disinflationary impact on the goods side, but offset by what happens on the services side. Tom, when you put it all together, what does that mean for the rest of the year? Does the labor market continue to have this tightness and push inflation even higher through the rest of this year? That's the view of Citi. It's not the view of everyone.
Sorry, John, I was sipping some Tang there, just trying to keep
Speaking to your team,
going
keeping it together.
John, on the data check here, I'm sorry.
Okay.
The dynamics here, John, for pros, there's some serious rates of change going on right now.
Sure, let's start with stocks. Not much happening, no drama, down 1/3 of 1%. Let's
nice
go to
recovery
bonds.
yesterday.
Yields higher on a 10-year. Nice move, wasn't it, Tom? 3% on a 10-year. Yields higher by 3
that
basis
was not
points.
me initially.
It's a nice move, Bramo. Great. German 10-year yield higher as well. What's missing here, the missing piece of this move in the core government bond market, Japan. And as Lisa has pointed out many times, I'm not even sure we can call it a market anymore. Not a single 10-year JGB traded yesterday. JGB yields are pinned at 25 basis points. Where are you going to push? You make that push in the FX market. Dollar yen, Tom, 134 earlier this morning.
In these stresses, you have to sum them together to a cogent idea of what to do with your money. It's been a terrible 2022 for that. Lots of losses taken. Beata Kerr joins us now, co-head of investment strategy at Bernstein Private Wealth. Beata, what is the new strategy, the amendment, the distinction right now for Sanford Bernstein?
Well, thank you for the question. At Bernstein, we've been thinking about the trade-off between stocks and bonds and alternative asset classes for quite some time, and this market has obviously posed some unique challenges. Talking about the increased correlation between bonds and stocks this year has been an extraordinary challenge. But what we see today is real opportunity in the high quality, intermediate duration municipal space. You were talking about it earlier. Yields are up, and they are up to levels that we have not seen in an extended period of time. So we think a lot of the selling pressure that we saw in the first quarter on the bond market is going to ease as we come into the summer. And the tax equivalent yields that we're seeing in this asset class today are really starting to approach almost 5%. So we see an attractive entry point for people that are in cash into that high quality intermediate duration municipal market.
And Piana, where does it leave credit, corporate credit?
Well, we actually see quality in corporate credit. And when you look at the credit markets broadly, including high yield, because our base case is a mid-cycle slowdown and not a recession, certainly in the next 12 months, that is our base case, we're okay leaning into credit, including high yield. So being active in today's bond market is even more critical than ever. So we like credit as well.
Beata, how do you brush off some of the threats from Deutsche Bank's credit team that just put out this report that we're going to see a default cycle unlike what we've seen over the past decade, that we're going to see defaults seriously pick up probably around 2024 as we do get slower growth and given the glut of debt that a lot of these companies have incurred?
Well, I haven't seen their report, but what I can tell you is that our fixed income portfolio managers are managing the portfolios for today. What's happening in a cycle in 2024 is not the market's current concern. what we have been handed today is yields that are substantially higher than we've seen in practically a decade. And today, of course, we're going to be all eyes on the CPI report on Friday and continuing to measure that output versus the growth that we see. And our base case remains a mid-cycle slowdown. And that means that we don't see a tremendous increase in defaults. In fact, we see corporate balance sheets that are still really high quality. And we see a consumer who has net positive wage growth and entered this cycle with very strong balance sheets as well. So there's clearly vulnerability on price, but it's something that we're going to keep a close eye on, and that CPI number is going to be instructive this week.
Forgive me, that's exactly where I wanted to go. CPI, what aspects of it are you looking for? How are you going to use it as an instruction tool ahead?
Well, you were actually talking about it right before I came on, this balance between goods and services. That is the story of the year. It's going to be the story of Friday. We do see some moderation in the number likely to come. And the biggest moderation we think is likely to come from the housing market. With mortgage rates over 5% now, the highest number that we've seen in a decade, we have already started to see signs both in the price number as well as mortgage applications and refis. So eventually that's going to make its way over into owner equivalent rents, the biggest component in the services area. And that transition, we hope, from goods ultimately peaking to some moderation in services will take some time, but we're going to be looking for evidence of all of that on Friday's report.
So you think there could be some downside risk to the print on Friday, correct?
Well, we think we're optimistic that we've seen a peak. We're not calling a peak in the CPI, but we think we could start to see some early signs of that starting to ease.
With that in mind, what's the balance of risk around how the market will respond to it? Is it asymmetric? Do you think there's more upside to the market based on what we could get from a downside print relative to downside of the market from what we could get from an upside print?
Well, the equity markets today have really been pricing in risk at a high level. This drumbeat and chorus of recession risks over the last quarter has been driving the downside in the market. But what we see in the market in terms of earnings outcomes is actually much more positive than what the market has implied in terms of price. We've got a U.S. equity market today trading at about 17 times earnings for end of year. That's 4 points lower than where we started the year. So honestly, we think the equity market is going to be looking for direction in terms of positive momentum on that inflation change.
Bianca, thank you. As always, awesome. Bernstein, Private Wealth Management, into Friday, looking ahead to inflation. Just to give you the numbers, Wall Street's going to focus a lot on that core month-over-month figure. The estimate so far, Tom, 0.5% in our survey. That's down from 0.6. I think a lot of the country, though, is going to be very focused on that year-over-year headline figure. That's what you hear about in a lot of the news. That, Tom, the estimate, 8.2%, just a little drop lower from 8.3. All that can change in the next few days, of course, but that's the survey so far.
Yeah, I'd go like David Rosenberg up in Toronto and parse it out and see what it is. Lisa mentioned it earlier, the subdivisions of inflation really matter. John, we've been sort of non-equity today, and I really want to mention the lift we saw in equity yesterday afternoon, and Alice Sanford Bernstein and Beata just there. The calculation of free cash flow forward out of these shocks, including the inventory battle, moving from just-in-time to just-in-case inventories through the pandemic, the analysis of what free cash flow is going to do into the end of the year and into next year, to me, is a massive mystery.
And Tom, you've got to pay attention to how the market responds to that incoming information. Target closed lower, but only by 2.3% yesterday.
You called that.
I think it's notable. Well, I raised the question. I wouldn't say I called it.
No, you totally did. You said that interesting people see where it ended.
Rambo, if I was wrong, I wouldn't have mentioned it.
I know exactly. So you could just take a victory lap. Go ahead.
No victory laps. Okay. No
you were out of at 8:40 a.m. yesterday. You were buying out of the money Target.
Let's behave. Tom, I've just got a message. Lisa and I both got the same one. TK's Unreal Yield on Friday. Just a bit of a rebrand. And let's see, you could own this one into the summer. I'll do summer Fridays for the rest of the summer. And you can do TK's Unreal Yield at 1 p.m. Eastern Time.
Everyone can watch.
You've gone so quiet. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. More problems for Credit Suisse. A Swiss lender has issued its 6th profit warning in 7 quarters. It expects a loss at the group-wide level and investment bank in the 2nd quarter. Bloomberg has learned that Credit Suisse is considering a round of job cuts, part of a renewed push to cut costs. The OECD says the world will pay a hefty price for the war in Ukraine. The organization slashed its outlook for global growth this year from 4.5% to 3%, and it doubled its inflation forecast to nearly 9% for its 38 member countries. It is a widely awaited study on the Omicron variant that could pave the way for another round of boosters in the fall. Moderna has said its COVID vaccine that targets Omicron generated a superior immune response against the variant compared to its original shot. The trial is one of the first to examine whether Omicron vaccines may offer better protection against the strain. In San Francisco, residents voted to recall progressive district attorney Chesa Boudin. Boudin tried to reform the criminal justice system, but critics accused him of being too soft on crime. About 60% of those voted favored ousting him. He will be replaced by an interim district attorney chosen by the Mayor London Breed. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
The Fed, I think that they recognize, look, they are missing on their inflation mandate. They need to get that under control. They're going to be hiking reasonably aggressively at least the next two meetings, and then probably guiding the market to expect further rate hikes.
Mark Cabana there of Bank of America from New York City this morning. Good morning. Futures lower by 1/3 of 1% on the S&P, and the Nasdaq 100 down 1/3 of 1% also. Special programming announcement coming up on Friday, 1 p.m. Eastern time. I've got a team to make the graphic, Tom. There we go. TK's Unreal Yield coming up at 1 p.m.
That photo, Nixon was president when that photo was taken.
That was a special photo, Tom. You know, just to encourage you, the big debut coming up on Friday. And through the summer, until Labor Day, this will be every single Friday at 1 p.m. Eastern time.
He's going to walk off set.
As I just get a bit of rest and get ready for the end of the year, Tom.
Okay, we're going to talk economics right now and save the show. But first, with David Blanchflower of Dartmouth College, I must ask, Page is out saying that Gareth has to play regular games to get to the World Cup for Wales. I mean, it sounds to me like he's destined for Cardiff. What do you think?
Sounds like it. We survived this year, but Wales into the World Cup seems quite a big deal.
Are you willing to donate some money here for Cardiff to play the big ticket for Mr. Bale versus going to the Tots?
He sounds pretty expensive to me. You and we'll send him $20.
Yeah, John, pick it up here. You know.
Oh, you want me to get us out of this?
Yeah, well, you know, that's the only reason I had Blanchflower
Danny,
on
let's
was to
start
talk
here.
about Cardiff.
I think where you've been tremendous over the last 10, 15 years, particularly, is to provide this different perspective to the consensus view. You did that in the previous cycle with the labour market. Everyone used to talk about a tight labour market. And by the time we got to the end of that cycle, a lot of people looked back and said, maybe not. You're trying to do that again. I wanted to start with the data point, and that was the amount of credit, the amount of borrowing that consumers are making at the moment. What do you make of that, and what does it speak to?
Well, obviously, the starting point is mortgages are now obviously pretty high, and we're seeing slowing in applications, and presumably we're seeing slowing in that housing market. I mean, the other part of it is presumably what we're seeing are people being stretched. And you might expect as they're being stretched that they resort to credit cards and, trying to pay the bills as they go. So I'm not exactly sure what to make of it. I mean, I think the answer is that, down the road, we're probably going to see some defaults. But I think your point is good in the sense that much of the discussion that I hear is really quite unbalanced. I mean, we hear all the conversation about the Fed's going to, the last commentator, the Fed's going to two rate rises and so on. Well, that's fine. It really depends, however, on the data. And I think something that really sets us going is the OECD forecast this morning, which again to me looks really too optimistic. But they cut the global growth forecast from 4.5 to 3, and it certainly looks to be too optimistic. So I think the evidence going here is that we're going to wait and we're going to look at the data. But I think everyone seems to be saying the same thing, and there's a clearly credible argument to make that output is going to slow much quicker than you think. It's time to sit and watch and wait. And essentially, that's the position that the ECB and the Bank of Japan have taken. So I don't think we've seen a very balanced discussion. I'm not saying I'm right,
Danny,
but I think, go, Lisa.
Let's just clarify this for a second. What is the correct policy prescription in your view? Is it to not raise rates at all anymore in the Fed, by the Fed?
No, I think the answer is that we really have no idea. We have no historical precedent on what to do. There's no data points. Perhaps the only data points we have are 2008 and 1929. And so we really have to be dependent on a set of scenarios. Scenario 1 is inflation keeps rising. Scenario 2 is COVID moves onwards. Scenario 3 is output collapses. People start to default on things. Depending upon those sets of scenarios, we would have to respond. The Fed has to say we're dependent on the data. And my view is that it's perfectly feasible to argue right now that rate cuts are on the table. I mean, one possibility is they're on the table. We'll sit and we'll wait and we'll watch. But suddenly some bad data comes and all the commentators saying they're going to raise X times and so on, and we know what's coming. And the only issue is whether it gets to 4% or 3%. Well, that depends on the data. And the first thing to say today, the OECD realizes that they got their output call wrong. And I was looking at France. They're forecasting positive growth for France, the weakest for the UK. They all look overly optimistic. France has just had its first quarter GDP reduced from 0 to negative 0.2. So are you really going to argue that it's all going to be just fine in quarter 2, quarter 3, and quarter 4? I think the answer is we really don't know, Lisa. We really don't know. And to actually argue we know what's coming is just a wing and a prayer. We don't. There are counter arguments on the side that the labour market is much looser than you think. I have strong views about that. I think it is. I think people have completely got the labour market wrong, as I've said for a decade. I'm happy to talk more about it, and I've been thinking and working a lot more recently.
But Danny, do you think that the reason why the Fed is taking the approach that they have is because it is politically infeasible for them not to come out with a much harder line, despite the fact that, as you say, there could be a more material slowdown, but right now that is not the main economic problem facing the U.S.?
Well, in a sense that, I mean, you may be right, but the reason that you have an independent Fed is to try and cut through that political push. I would have liked to see a more balanced discussion on the one hand, on the other hand. I mean, yes, you argue that politically, but that's the reason you have an independent central bank to say, hang on, folks, we're going to cut through the political rhetoric. We're going to cut through what politicians want us to do. And we're going to try and look at the data and understand what's going on. And I don't really see that. I mean, I think if you go to the UK, the votes on the MPC for rate rises last month, and 3 people wanting more, a meeting coming next week. And basically, there is a counter argument to say that you shouldn't raise at all. So I'm not saying that you shouldn't, but I'm just saying that the argument is much more balanced. Output potentially is going to fall. And the big thing we know is that at points where return downs come, the revisions get you. So the consumer confidence data around the world is predictive of recession. It's predictive of recession in the United States, in the UK, in Japan, and in Europe. Now, you can ignore it, but this is the best data we have. And it just strikes me that all of these folks, maybe politically being pushed there, but they're being pushed into making an error. And what you need to see is a balanced discussion saying, on the one hand, the consumer confidence data are saying this. In Europe, we've certainly seen a collapse in the last 2 months. Collapse in people's views about their financial situation, collapse in consumer confidence, which and we know with Christine Lagarde and the ECB is taken very seriously. So if they're taking it very seriously, why is there not a serious discussion at the Fed? The worry is the Fed is beaten by events, and it starts to see some horrible data that it's really not prepared people for. Horrible data on the real economy, on the labor market, on output, on retail sales, on defaults. So I think, it's just we need to balance this discussion. And I certainly think that, if you look at the FOMC and you look at the NPC, the discussion is unbalanced, and that's potentially dangerous.
Danny, one thing we can agree on, groupthink is deadly. It's great to catch up, buddy. Good to hear from you. Danny Blanchflower there of Dartmouth. TK, a lot of groupthink through much of last year, and some people might argue that's why we are where we are.
I would watch the outliers from the groupthink, including this morning, dollar yen, wow, 134.20.
Futures down 0.4% from New York. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
From New York City this morning, good morning to you all. Your equity market looks like this, down 0.4% on the S&P, on the Nasdaq 100, down 0.4%. In the housing market, there's a canary coughing. It's not dying, but it's coughing, just a little bit. And you're hearing it cough just a little louder. Mortgage applications, Tom, down 6.5%.
Everyone's watching this. Of course, we turn so much in New York City to Jonathan Miller and Miller Samuel. But, John, it's a national study, and that's because of the fears here, the ramifications if and when it snaps.
And how does that fold over to the broader economy, Tom? Can you imagine a scenario where housing prices start coming down, but energy prices are still higher?
No, can't imagine that. But is it optionality? You got to look at it. Absolutely.
Difficult moment, TK.
No question about it. Futures at -18. Of course, Dow futures here -152. Right now with us on housing and a beautiful microanalysis he does, Ian Shepherdson, chief economist, Pantheon Macroeconomics. In your United Kingdom or in this United States of America, what's the #1 thing we get wrong when we analyze house price ascent and rental ascent?
I think the problem is that people look back instead of forwards, because especially in the US market, we get a lot of information telling us about where housing is going, but markets tend to focus on things like the home sales and home price numbers, which kind of tell you where we've been. And the mortgage numbers that you just mentioned are a great indicator of where we're going, and they are horrific, even though... If we look
define horrific, that's a large phrase for Shepherdson.
Okay, so they peaked in December, and by May they were down about 25% from the peak. They're still falling, so this month, June, by mid-year, we'll probably be down about 30% from the peak. I don't want to annualize that, it's too scary, but it points to a massive fall in home sales, which is already underway, especially in the new home sales.
I have the clearest memory of 05 or maybe middle 06 looking at the potential mean reversion of housing prices. And we had a very mean reversion of housing prices. I believe that was the year. I could be off by 5 years. Are you looking at this, is it a mean reversion or more of a housing plunge?
This is more of a volume plunge story. So, yeah, what we saw in the Great Crash was a huge wave of forced selling from people whose adjustable rate mortgages reset when the Fed went from 1% to 5.25. They couldn't make the payments. We had a wave of forced selling, plus all the new buyers disappeared. So prices completely crashed alongside volumes. This time's different because we haven't had an adjustable rate mortgage boom over the last 10 years. So all that's happening is that the new buyers are disappearing. But they're disappearing at such an incredibly rapid rate that the market is going to move downwards in volumes very, very quickly. We're already seeing it in new homes. We'll see it in existing homes over the next few months. And it's possible that that speed of that drop in sales is enough to trigger maybe a short-lived decline in prices rather than a sustained multi-year crash like we saw back then. But the psychological shock of seeing home prices go from plus 20% just to -5%, I think would be quite big. And the other thing we have to remember is that if we're going to see a really big drop in home sales, then everything is connected to that. A lot of retail sales, building materials, furniture, electronics, appliances, all of this stuff tracks home sales. All of these businesses are really going to suffer when the volumes drop by 30%.
Yeah.
This is underway now. The process is just beginning.
Ian, that's where I wanted to go. As a tea leaf, as some sort of canary, what does this serve in order to say about the pace of the potential, I don't want to say downturn yet, because perhaps that's too dramatic, but just slow down in economic growth in the United States?
Yeah, this is an interesting one because, housing, when it crashed in 05, 6, 7, 8, was the whole economy. And it pulled the rest of the economy to pieces with it for years. This time around, I think it's much more kind of siloed. So I think it's entirely possible to have a housing rollover without the rest of the economy following suit. Now, this is, not something that we've seen frequently, but it's possible this time because the circumstances are so different to anything we've seen before. So, we've still got consumers sitting on $3.5 trillion of excess cash, which they seem, at the moment anyway, to be quite happy to run down every month in small increments and keep the retail sales numbers going. And remember, consumption is nearly 70% of GDP and housing is 5, 6, 7% of GDP. So it is possible for housing to roll over and the rest of the consumer to keep going, but, we don't know. And we've not seen this before. It's possible that the rollover in the housing market crushes confidence to the extent where people say, hey, I'm going to pull back on my other spending. But this is really uncertain, and what I think hasn't happened yet is this uncertainty has not permeated through to markets or through to the Fed in terms of their interest rate discussions, where housing still doesn't really get a mention. But I'm pretty sure over the next few months, maybe as soon as the June meeting, but maybe we got to wait till July, September, they're going to have to acknowledge that housing is not just softening around the edges, it's actually rolling over, and that rollover is going to really make the policy conundrum even more difficult for them. So this is a real potential threat to this 50-50-50 idea that markets have got very deeply embedded, and I think we're going to have a rethink. Now, I don't know about the timing or the extent of this rethink, but I'm pretty sure it's coming because we can't just ignore a housing meltdown on this scale.
Yeah, and here's the problem for the Federal Reserve. They wanted tighter financial conditions to bring down inflation. A key component of inflation is rent. Rents have increased dramatically. It's not clear that it will immediately send rents lower if you do see a complete loss in the momentum in the housing market. How much is that part of the problem, that rents are going to stay higher and even go higher, even if you do start to get a deceleration, even a drop in housing prices?
Yeah, this is an issue for them because even if prices drop tomorrow, I wouldn't expect to see that filtering through into rents until next year. So they're kind of stuck with that for the foreseeable future. The silver lining for the Fed here is that wage growth is actually a bigger driver of rental inflation in the CPI than home prices. And wage growth, I think, I'm pretty convinced now, is moderating. It isn't weak, but it's certainly a lot less dramatic than it was maybe last summer, where we saw annualized numbers like 6% plus. We're now down maybe at 4%. So that might give them a bit of relief, but it is going to be awkward for them because that rent component is slow moving and it lags, and it's 40% of the core CPI. So this is they're going to end up having to perform a sort of a juggling act here, whereas at the moment it's very easy. We just bang the table and say we're going to be raising rates to dampen down inflation. That's just like a straight line narrative. It's going to become much more fuzzy and much more difficult and much more multifaceted as the summer goes on.
What's important to me, Ian, is the job formation out of the pandemic was remarkably linear, whether it's curvature, log, whatever, but it was step by step by step, beautifully sequential. I don't buy that on inflation. What point is where the next move down in inflation gets hard? Is it at 5%, 6% gloomy, or can we make it to 4% before we really have a challenge to drive inflation lower?
Well, a great deal depends on energy prices, which I'm just going to put to one side and call it a wild card because I don't know where.
Well, take core. Let's work off core. 6% right now.
So if we look at the core, I think we've already seen a moderation in some of the components which are not really sensitive to COVID and are more sensitive to wages. So, airline fares are still going crazy, but that's a very small component. You look at the bulk of it, that moderation in wage growth, I think, is already beginning to creep through at the edges. So it's hugely dependent on the view that you take of the labour market. Now, right now, the numbers are all over the map. We've got, 11 million job openings, which is a ridiculous number, 2 to 1 with the number of unemployed people. Yet wage growth is already moderating. Now, which is going to become the dominant force over the next 6 months? I just don't know. I've got no precedent. I can't point to a previous experience to say, well, the last time this happened, the outcome was X. There is no last time. But if the wage numbers do continue to moderate and we see just a leveling off in energy prices, then I think we can see inflation early next year getting really back down to some quite low levels, which will kind of transform the policy debate. And hopefully if the economy hasn't rolled over by then, people will be starting to talk about, well, hey, maybe this expansion is going to have some legs. And we don't need to think about a recession in 23 or 24. Maybe we can look at a cycle more like the late 90s, which lasted for several years, despite, substantially higher interest rates than we have now. But this really is an exercise in threading the needle, kind of in the dark, wearing gloves. It's not easy.
Ian, being in the dark, what's your highest conviction right now in terms of what we expect to see through the remainder of this year?
Well, first of all, housing is going to be the talking point in the second half of the year because it's to me, this looks like a total disaster area, really coming up very quickly. And the second thing is that I'd be amazed if the Fed is able to go 50-50-50 at the next few meetings in a straight line and without any pushback from markets and without any acknowledgement of what's going on in the housing market. The third thing I'd say is that the rest of the economy, to me, actually looks pretty good. We've got threats from every direction. We've got China's COVID mess. We've got the people at the bottom end of the income scale being squeezed by gas prices. We've got higher food price inflation, but we've got consumers with $3.5 trillion of cash in the bank, and that, to me, keeps most of the spending going, even if housing rolls over.
Ian, thank you, sir. Great to have you with us in New York City. Ian Shepherdson there of Pantheon Macroeconomics. Greg Jensen of Bridgewater out with an interview in the Financial Times this morning. Here's a quote for you. They may tighten in a very strong way, which would then crack the economy and probably crack the weaker companies in the economy too. Tom, they're betting on a sell-off in corporate bonds in Europe and in the United States.
That's a discontinuous feel of going from point A to, say, point K, and along the way there'll be massive data dependency, which will allow the Fed to adjust. They're not going to do it in a big jump condition. They're going to be massively data dependent and adjust as they go.
It is the last 10 years, Lisa, in reverse for policymakers on so many fronts.
Greg Jensen is not alone, and I was referring to that Deutsche Bank report also talking about more defaults to come in a real default cycle. How do you parse out what corporate credit is worth at a time when suddenly 10-year Treasury yields provide actual yields, right? Where all of a sudden the Fed is not about giving a put or trying to calm markets, but to actually get things a little tighter. This is uncharted territory, and people are trying to understand what the corporate credit market used to look like and transpose that into the size of what we're looking at right now.
Toxic brew.
Toxic brew, Tom.
I'm not saying that you come
you've
to
been
me
asking about this. I agree.
On higher corporate credits,
Totally.
I'll give the argument.
Totally. And you've been asking for this for a long time, just reintroducing a little bit more price discovery.
I'm not asking for it.
You've been saying that we need a bit of price discovery in the market.
People are worried about zombie companies getting money that don't deserve it. And that's basically the fear. And are we going to see a reversion to some sort of lack of that free money? And what does that look like?
I agree with you. I'm not sure why Tom's being so mean this morning.
I'm toxic brew dependent.
Just getting ready for Friday, Tom. At 1 p.m. Futures down 0.5%. On the S&P, you're furious about that. And the Nasdaq down about 0.5% as well.
My scheduler did not. I got a staff of 14, John.
Not going to work out.
Scheduler, we're going to get an intern. The scheduler's gone. We're getting an intern in.
You do it on location, Central Park with a cigar.
Great. I was thinking
you do it. I'd watch that.
Can I do it at the bar at Benoit?
Of course. Julie Bill coming up. Michael Kontopoulos, David Stubbs as well in the next hour on Bloomberg TV. From New York City, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the First Word News, I'm Leanne Gerrans. Credit Suisse is considering a round of job cuts after warning of a second quarter loss. Bloomberg has learned the cuts would be spread across divisions, including investment banking and wealth management. It was Credit Suisse's sixth profit warning in the last 7 quarters. Former German Chancellor Angela Merkel warns that isolating Russia isn't possible long-term. In her return to the public arena, Merkel said in an interview that Vladimir Putin made a big mistake by invading Ukraine, but she said there's a danger of Putin forming an alliance with China if he does get boxed in. Microsoft is joining the list of prominent tech companies cutting back in Russia following the invasion of Ukraine. The company says it will significantly scale down its operations. Microsoft had already suspended new sales of products and services in Russia. More than 400 employees will be affected. In LA, a billionaire developer will take on a veteran politician in the race for mayor. Rick Caruso will face Congresswoman Karen Bass in November. Caruso won 41% of the votes in yesterday's primary, while Bass won 38%. Both are Democrats, although Caruso is a former Republican who did not switch sides until January. And the son of the founder of Walmart, Rob Walton, is leading a group that has agreed to buy the National Football League's Denver Broncos. ESPN reports that the Walton Group offered almost $4.7 billion. That would be the highest amount ever paid for a U.S. professional sports team. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost. So it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What these companies are doing is acknowledging that there is weakness ahead, and that you have some companies that are saying, you know what, we're not even going to offer guidance because we just don't know. So I think that what is happening is that you are continuing to see that floor be revised downward, but I don't think that ends up being a very solid floor.
Sam Stovall, just brilliant yesterday with CFRA on free cash flow and the use of cash of corporations off the shock of Target yesterday. Really no equivalent today. Futures at -18, and the VIX, I'm going to call it quiescent, 24.61. On the turmoil of Japan, Kriti Gupta.
Thomas, the dollar yen hits 134, of course, off the comments coming from Governor Kuroda saying that monetary tightening is not suitable here. We have to look at the ripple effects, and that's really brings me to my chart of the day. You have the offshore yuan relative to the Japanese yen, and a massive, massive shout out to Cameron Krice here. And here's why. These are both major Asian exporters, both major net importers of oil, and both are getting hurt by higher commodity prices. Both are also competing to export to the rest of the world. The significance here is when this currency pair, once again, the offshore yuan relative to the Japanese yen, hit that 20 level back in April, and then going further back in 2015, it has created some devaluation in the yuan. In fact, back in April, when it hit that 20 level, the dollar versus yuan started fixing higher. Once again, speaking to the fact that they are looking to compete more with the rest of the world, specifically with Japan. So when we're talking about simply how much exports are going to cost and how much weaker the Japanese yen or the Japanese yuan could get, keep an eye on this currency pair.
Kriti Gupta, thank you so much. Greatly appreciate it. We pulled him off of a beach. Damian Sassauer joins this morning with Bloomberg Intelligence on emerging markets. Damian, is Japan an emerging market? Is their central bank theory so screwed up that they're literally EM-like with their zombie companies and their completely illiquid bond market?
I don't think they're EM-like at all, but what I do think is the impact that Japan is having on emerging markets, most specifically China, and Kriti alluded to it, is significant. I mean, look, Japanese exports are weakening. They're becoming more inexpensive in the broader market, and that is definitely going to weigh on the China yuan, the Korean won, and the rest of the Asian complex, and we're seeing that.
Are we at a tipping point? A lot of people we've talked to have said 135. We're advancing weak yen to a 135 level right now. New high, new weakness for the day. Yeah. 134.29. Do you have a 135 as a Sassauer radar? Or is
140, 150, oil at 200. No, I'm kidding. I mean, these are big numbers. I mean, it's very difficult to pinpoint a number.
What is the big number for their institutions where they blink?
I think we've passed it. I mean, I think we're far gone. I think where the yen is, there's really no top to it now. With 20 at yuan yen, with 135 at dollar yen, I mean, no one really knows where the top is in many of these markets. And so the market's going to pull on that thread. You take what the market gives you. And right now, the path of least resistance is to short the yen versus all G7.
Damian, on a credit perspective, there's still concern about what's going on with China and what the slowdowns, the lockdowns, the reopenings mean in terms of the entire region and the exports we saw fall off a cliff to the United States from China. How are you gaming out where China is and what the next shoe is to drop when it comes to the bleed-through effects on the rest of the developing world?
Well, the next shoe to drop, Lisa, is total social financing. We're going to get that print this week. We know what happened last month. The market was calling for 2 trillion yuan of liquidity injected into the system. It came in with less than $1 trillion. And the problem really is that Chinese banks, it's not that they don't have the cash to lend, it's that there's no demand for credit in China because of the lockdowns right now. Hopefully that's changing, right? We saw the PMIs improve a little bit last month. But we're looking to that TSF figure. I mean, we're looking for new yuan loans. We're looking for loans to medium and small households. We're looking for a big number of over 2 trillion yuan. And even if we do get that, they're going to run into a liquidity crunch come June, July, just based on some of the back of the napkin numbers I'm looking at, Lisa. They're going to have to cut the RRR rate. And, you know, we only saw a 25 bip cut last time. It may need to be more than that.
Have some of the Southeast Asian trading partners with China and frankly the rest of the world really factored in perhaps a 3 handle on the GDP print from China, even if it's not said by officials, if it's something like that in real terms?
Well, I think El Salvador, I mean, my goodness, they have a Bitcoin bond that's coming due next month, $38 million coupon payment, and their Bitcoin that they bought in the market over the last few months is down 40 million. So how are they going to make that payment? I mean, these are the issues that are really front and center for me across emerging markets. The Asian complex is managing really, really well. The inflation impulse in Asia is far less than we'd seen in other regions, specifically Latin America. And so, you know, they're able to weather the storm, at least in the near term. I'm talking the Philippines, who have already started tightening, and others like Malaysia.
Oh, come on, Damien. I'm looking from call it an 80 to a 134 on yen. Is Japan devaluing their currency? Is that the end strategy? Is that the leakage out of the steam kettle of this fictitious fiscal effort?
I mean, that is
it's a devaluation.
It's a devaluation.
President Trump, if he was president, would be out on Fox this morning screaming bloody murder about this.
Tom, you sit up here all day long talking about how central banks target unemployment and inflation at the most fundamental level. They're targeting currencies, right? Because without currency convertibility,
to the people of Japan, or frankly to Toyota, of a forced depreciation of the currency over decades.
A lot more tourists. No, I'm kidding. I'm joking. But, you know, truthfully, that's what they're kind of leaning on, is the fact that they're going to see more people coming into Japan, more people spending money in Japan, more people kind of seeking out Japanese goods and services. And so maybe that is kind of the competitive devaluation that we're in the midst of.
Lisa, this is like kryptonite, the way Sassauer's doing this. Do you realize, Lisa, and for those of you on radio, Sassauer's wearing a New York Yankees tie? And he expects
I didn't even know that.
To concentrate?
I don't think anyone's expecting that. I do think that the yen right now is a major issue, and I do wonder what it means in terms of central bank action, at what point policy prescription has to change. Damien Sassauer of Bloomberg Intelligence, thank you so much. And on that point—
Are you serious? The yen matters because the Red Sox need middle relief.
Hey, look, I just have to jump in here.
Please.
I mean, the Yankees have the best record in baseball, the best record since 2001, and we have Nestor Cortez on the mound tonight.
Can they stay healthy? Damien, it's unbelievable what they've done.
Yeah, unbelievable.
It's unbelievable.
But you don't watch baseball anymore. You only watch the National League.
I watched National League, but they even ruined that. You know, I watched some Cubs last night. Hi, Lisa.
How's it going?
It's going good. Damien Sassauer, thank you so much.
I was trying to make a point, actually, about when policymakers' hands were going to get basically called. And we're seeing that with China with respect to reversing some of the tightening in financial policies, and they're trying to loosen them up a little bit more. And how much have we really seen the peak tipped in Japan as well?
I would say, Lisa, you just don't know when it's going to push, but it just keeps going. The vector of Turkish lira, 117.19. I made a joke. Lavrov's going to show up at 17 and leave with an 18 handle. And I'm sorry, I go back to the elephant in the room, which is through the show this morning. Lisa, yen has moved out 134.37. What are they going to do? Turn purple at 135?
When do they start to care? When do they start to realize that this is increasing their imported inflation in a dramatic way?
They won't show that they care. They'll just fix it. And how they fix that is fascinating. We'll unfortunately have to have Damien Sassauer on with his Mets tie tomorrow. We will continue, folks. Futures at negative 21. Need to stay with us this morning. This is Bloomberg.
the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Live from New York City this morning. Good morning, good morning. No real drama in this equity market, down just a little bit, off by 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue, the downgrades piling up.
We downgraded our stance.
Expect downgrades.
Of course, the situation is quite challenging at the moment.
Sentiment probably has, hit peak bearishness.
Yes, we're squarely in a slowdown.
We have all the components in place that would make that happen.
There's a lot of tightening priced in.
At some point, demand is going to start to respond.
Everybody's concerned about what the next 12 to 18 months will bring.
Global growth will continue to slow.
We have two problems, inflation and supply.
It's a tale of two halves.
The second half of the year does slow down considerably.
We need to get into Q3, see what happens.
Definitely a slower trajectory in the second half of the year.
Joining us now to discuss, Julie Bill of Kane Anderson Rudnick, Mike Kontopoulos of RB Advisors. Julie, I want to come to you. Typically, and forgive the sarcasm, the snark, when the OECD and the World Bank starts catching up, you're meant to start looking the other way. Julie, are we at that point yet?
I don't think we're quite at that point yet because I don't think it's clear exactly how the consumer is turning out right now. It's just we need a little bit more time and a little bit more data. We have so many factors that are making it very hard to understand exactly where we are. We don't know where we are in terms of supply. It seems like we're going to be choking on a lot of inventory. We don't know exactly where we're going to end up on rates. And I think the employment picture is starting to get a little bit more complicated. We're hearing so much about layoffs in Silicon Valley, and the question is, will the frontline work continue to be strong? I think that's where we need to focus our attention.
Michael, what's your take on this?
I think, Jonathan, that the growth story still remains intact. We are seeing obvious signs of plateauing in some of the signals out there, but there's nothing suggestive of a near-term recession. The consumer is very healthy. PMI surprised to the upside. Continuing jobless claims are very, very at a very great point right now. Obviously, unemployment is incredibly low. I always throughout my career, I've always learned that when you get the reports of layoffs in the paper of individual companies, you're supposed to look the other way because, of course, everybody always, reports on the layoffs. No one ever reports on the hiring. So I think we need to see a lot more data before we sit here and call it a massive slowdown in the economy. And in fact, as I've said before on the show, I think most likely the economy can handle much higher rates than what's appreciated because the consumer is in such good shape. The transmission mechanism of higher rates to the real economy is not what it once was. Corporate balance sheets are strong. So, we still think there's room for the economy to run. Of course, that doesn't necessarily mean risk assets, outperform, but we do think the economy is in fine shape right now.
Julie, let's talk about that consumer. I know what you're worried about, and you've said it. I've read your notes. The tsunami of inventory hitting just as the consumer weakens. Is that a problem for certain retailers or a problem for the whole of this market?
Well, in the U.S., the consumer drives a lot of the market, so it has implications for the rest of the economy, but for retail in particular, it's a really big problem. If Target, a company that's at large and usually quite adept at managing its inventory, is choking on its own inventory, and we still have a large backlog of ships in Asia coming towards us, that's going to hit right when there's the core back to school and holiday season. That's when retailers really make their money. So I think there's nothing but trouble ahead for retail right now.
Julie, talk to me about that inventory story at the likes of Target, though. Did you see that as a sign of weakness or a sign of bad execution, bad management because of a shift in consumer preferences?
I think it's both, right? I think when a lot of inventory is ordered, you have to think about it that's 6-9 months before it actually hits stores. So, 6 to 9 months ago, gas prices were very different than they were today. And, we still had the underlying effects of stimulus and a lot of pent-up demand. I think numbers will actually look pretty good through this summer because the pent-up demand for travel is going to be a nice boost to the economy. But then I think when it's time for back to school and holiday, it's really going to get kind of ugly.
There's an inflation story here as well, Michael. I'd love your input on it. You've got the goods side with some disinflationary forces here with this inventory build-up that Julie's speaking to. Then on the services side, you've still got that pent-up demand. How do you think one offsets the other through the next several months, through the rest of this year?
We certainly still have the huge pent-up demand on the services side, but you also have the war in Russia and Ukraine that's causing oil prices to spike, food inflation to remain high. I mean, you look at commodities still remain at an all-time high in terms of prices. So inflation is real, inflation is alive. It's not just one area of the economy that you need to pay attention to. It's really very broad-based. Wage growth is still strong. Housing prices are still very, very high, owner's equivalent rent. But then you also have the big secular issues, right? Deglobalization, an aging demographic that's actually drawing down on the global stock of savings and spending that into the real economy. That actually has an inflationary impulse. So I think inflation is here to stay. There's certainly reasons maybe to expect that we're near the highs. I wouldn't necessarily say we've peaked quite yet. Maybe we have, maybe we haven't. But I think there are lots of reasons, from commodities to wages to rents to the sort of more secular factors, to expect inflation stays where it is. You might get a little bit of shifting of inflationary pressures from goods to services as well. But I think at the end of the day, it might be closer to a wash than most expect.
25 minutes out from the open and bound, futures down about 0.5% on the S&P, on the Nasdaq 100 down 0.5% also. Yesterday, the World Bank cutting its growth outlook to 2.9%. This morning, the OECD joining in, looking for a 3 handle, just about 3% is their outlook. Katie Lyons, a big cut to the outlook from them.
A big cut, 1.5 percentage points at a global level. And when you look, there actually were some larger cuts for individual countries themselves. For example, the U.S. cut down to 2.5% growth for this year. For the euro area, cut down to 2.6%. And China, they say, is going to grow only 4.4%, which of course is well below Beijing's own target. Now, the organization is basically saying that the world economy is going to pay a very hefty price for the war in Ukraine, for supply chain issues, and of course, stronger inflation. And that is the other part of this, John. It's not just about growth outlook cuts, it's about inflation outlook hikes. The OECD doubling its inflation projection for its 38 member countries to nearly 9% this year. And of course, a large part of that driven by spiking commodity prices, oil front and center in that, with Brent up 56% just year to date. And of course, compounding, exacerbating that problem, the dollar hovering around 20-year highs, creating a huge problem for everyone trying to buy dollar-denominated goods. Oil, of course, is among them. When you put it all together, you've got hotter inflation and cooler growth, and a dilemma for central bankers who want to tame prices, but also want to keep the landing soft. And looking at the bond market, you can see some concern around that, in that, yes, the 2-10 curve is no longer inverted, but still it's only in between 20 and 30 basis points, depending on the day. That is a reflection of the fear that if there's too much aggression now, it means a recession later. And we actually heard Ray Dalio out overnight in an Australian newspaper talking about stagflation, saying that, yes, now it's central banks hiking and tightening, but in 2024, it's going to be a story of easing and cutting because of that stagflation, John.
2024 is not that far away. Kelly Knights, thank you. And this leaves the consumer trapped, getting squeezed. We've all seen it, haven't we, on the online shopping? You have the option, you're confronted with it. Buy now, pay later. Well, those buy now, pay later lenders are starting to feel the pain. The loan packages behind them are dropping in value, with new competition adding to the pressure as well. Shonali, we had to catch up this morning. What is going on, not just with Affirm, but across this industry?
It's a great question, because Affirm is still down pre-market today. As you've seen, it drop more than 75% already this year. Compare that with a PayPal, a little more diversified, but also doubling down on buy now, pay later, more than 50% decline this year. I'd love to tell you, John, that this is all about Apple, but you hit the nail on the head there. A lot of this is also the cost of financing. The securitization market hitting some pressure there, and of course that is going to impact a company like Affirm that funds about a third of its loans through securitized lending. But there's also this broader push on Wall Street. For example, Wedbush initiating Affirm at an underperform, saying that they might get a better cost of financing by getting a bank charter. You've seen also even bigger firms like Goldman Sachs pushing into consumer lending to lower that cost of funding. The question is a bank charter worth it for a firm like Affirm? You had Jamie Dimon just a couple of months ago talking about how Affirm started as a hot buy now, pay later company, and then also expanding now into different products like deposits. And the question here is now, is that enough to get it through this very difficult cycle? Will there be a washout in this space as we see job cuts starting to come out at other companies?
Shonali, I imagine this is not going to be the last time we talk about this year. Shonali Basak there, our Wall Street correspondent. Julie Beale, I know you've got things to say, so here's your chance. What are your thoughts on what's happening here?
Whole wash of buy now, pay later is an interesting business, because you think about it, right? None of these businesses have been back tested in a recession, right? And they're securitized against things like sweaters. So how on earth should we expect these businesses to perform when customers suddenly can't pay, right? I think they're going to pay their utilities before they're going to pay for their sweater. So I think, obviously, as a long-term investor, we've never really been interested in these stocks, but I think there's a more core problem with these businesses, right? And that they're targeting young people, and young people are suddenly being told, okay, you can buy now, pay later on your sweater. Your student loans might be forgiven. Please come onto Robinhood and trade on margin. I'm really worried about the financial health of the younger generation of consumers and the moral hazard that can be involved in that. So, for us, I think it's a concern, because I think it would take years to repair some of the financial damages that have been done, as many of these younger consumers have been overextended. And there's not a lot of financial education to really support them either. So we're definitely very concerned, and obviously not buyers of Affirm.
Julie, it's a really legitimate concern. I'll give you another one in the market specific. Have we got a clean read on which companies this trend has been supporting? Because if this starts to break down, how much of the earnings of certain companies do we need to start to reassess?
Yeah, I think then we're back on retail, right? It's so many of these retailers jumped onto the buy now, pay later because, look, it's a great opportunity for them to increase their basket size. And I think, the economics of that business start to look really, really poor if suddenly there's levels of defaults. And I mean, I've been shocked to see how quickly, the Affirm loan book starts to look really poor. And that's at very high levels of employment and strong wage growth. And still people aren't paying for their sweaters.
Mike, they're not going to pay for their sweaters. That's probably not a systemic risk. What might be is something more broader. Mike, I'm often thinking about where is the leverage, and I'm confronted by guest after guest who tells me consumer balance sheets, household balance sheets, they're strong. Corporate balance sheets, they're strong. If you think, Mike, where's the leverage right now? Where do you think it is?
I think there's the leverage is likely into the far sort of outer reaches of the private debt market more than anything else, right? If you think about what happened over the last 12 years, not just since COVID, but going all the way back to the global financial crisis, easy monetary policy, zero interest rates globally, At one point, 27% of all fixed income assets having a negative yield, generally low growth up until the post-COVID years. All of that incentivized a tremendous amount of risk-taking, a tremendous amount of re-leveraging on the private side of the economy, the shadow banking side of the economy. And so I think that's probably where the leverage is hidden, more so than in public companies and even on the consumer side. You know, that's wary of.
Mike Kontopoulos, Julie Bill, sticking with us. Futures lower by 0.5% with some movers. Here's Abby.
John, well, one of the top sectors on the year outperforming the consumer staples space, and we have a example of why. Today we have the shares of Campbell Soup popping higher, this on a much better quarter than expected. The stock up more than 2%. They beat. And it's interesting because higher prices lifted their sales. Prices that consumers are paying for the likes of Goldfish, their soups. Interestingly, organic sales were up even more, up 9%. Sales guidance was strong, and the company said that they expect demand to remain strong. So here's a place where consumers are really absorbing higher costs. Novavax up 8.3%. Their COVID shot has gotten the backing from the FDA advisory panel. A bit of a different delivery mechanism. Some have said that it could be very good for the booster, so those shares up 8.5%. To the downside, not by a huge amount, but we have Meta Platforms down 0.5%. The reason we're talking about it, John, this is the last day it will trade under the Facebook, the FB ticker. Tomorrow it will be under the Meta ticker. And then finally, Carnival down 2.4%. Morgan Stanley has turned a little bit chilly on the cruise line companies, cutting price targets across the board, saying that there are weak channel checks, growing macro risks, and rising debt costs. And Carnival is maintained at an underweight, John.
Abby, thank you. I will continue to call it Facebook because I still call Alphabet Google too. Abby, thank you very much. $4.96 is the average price for a gallon of gas in America right now. And the Biden administration knows it's got a problem.
Bringing inflation down should be our #1 priority, and President Biden has indicated that it is our top priority.
That conversation up next.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
But But we're not going to give up on the congressional agenda. We absolutely can't do that. When families are facing exacerbated costs in prescription drugs and health care and education and housing, we're going to do everything we can to get Congress on board in helping the American people to face this inflationary challenge. They talk about it just as much as we do. They need to pony up on the policy side the same way we're doing.
The White House confronting a problem. Gas and diesel prices jumping to the highest on record with the midterms just around the corner. This as the latest polls show waning approval of the president's handling of surging prices. Bloomberg's Joe Matthew joins us now for more. Morning, Joe.
Good morning. It's interesting to hear the messaging come from this White House, Jonathan. It's morphed over time here. It's become more deliberate as the White House tries to draw a distinction between what it can do, what Congress can do, and then, of course, what the Fed is able to do. You heard Jared Bernstein talking there on the lawn of the White House yesterday with ideas here that the administration is hoping Congress will be able to pass what we like to call the Bipartisan Innovation Act. This is the big piece of legislation that includes the CHIP Act. That's going to continue here. It's been stuck in Congress, Jonathan, for the better part of a year. The administration also trying to revive ideas from Build Back Better, things like ideas to programs to lower drug prices, maybe to expand the child tax credit. And there is an expectation that the White House will go for, Democrats will go for reconciliation to try to do that alone on just Democratic votes. But you heard Janet Yellen talking there yesterday. All of these ideas come with a caveat as well, or a reminder is a better word to use, that this is a global phenomenon, and shocks from the war in Ukraine and, of course, COVID have brought us this far. But, of course, Jonathan, we know that we were talking about high gas prices, high oil prices, and inflation across the board before Vladimir Putin ever invaded Ukraine.
In a big way as well. Joe Matthew, thank you, sir, as always. Some of the numbers in the future. We've talked about the gas price forecast from JP Morgan. They say that this summer could get crueler. Their words. We could end up at $6 for your average gallon of gas in America. On crude per barrel, $1.40, the forecast now from Goldman for the third quarter. And they think we could be stuck with that kind of number out 12 months. They're looking at the second quarter of 2023 at $1.30. Judy Bill, you've noticed something interesting about the correction we've seen, that what's worked is low-quality commodity companies, and that's not normal. Can you walk me through your observation and why you might be leaning in a different direction?
Right, I think it's been kind of an atypical correction where, normally when people are concerned about a slowdown, there's a flight to quality businesses, ones that have really durable earnings that can do well even in a difficult macro. But because this is an inflationary environment, they've actually moved towards commodity markets. For us at our firm, where our average time horizon is 5 years, I'm a little uncomfortable loading up on commodity costs when it's really tied to, Putin's midlife crisis. That doesn't sound like a great place for me to be putting all our money in. So we're more focused on those quality businesses, which are actually kind of on sale right now. You see them in some of the software names, but a name like Market Access and Financials, these are businesses that have a lot of earnings consistency, and that's what really gets rewarded when we are in a more uncertain macroeconomic environment.
I think a lot of people calling the commodity market need a therapist much of the time. Forecasting crude is really, really difficult. Mike Contopoulos, can you make a call, though, that we've seen the high on Treasury yields without seeing a high on crude?
Well, I think that we likely have not seen the high in Treasury yields, and it can be independent of what's happening in crude, quite frankly. When you look at the government debt, there are four main factors to drive Treasury yields. You have inflation, which clearly oil is going to have an impact on, but you have economic growth, you have the size of the Fed balance sheet, and you have the federal funds rate. And we know all four of those factors are suggestive of higher, not lower yields. And I actually think that over the next several months, QT, in the process of no longer reinvesting the matured principal of the Treasury holdings of the Fed's portfolio, could cause some indigestion in the 10-year. So I think regardless of what happens with oil and inflation, you likely haven't seen the highs on the 10-year this cycle. And that, you might reach there in the next 1, 3, 6 months.
Let's talk about that then, Mike, because I know where you stand on the front end of the curve. Your view on the Fed is that this economy is resilient. It can take a whole lot more. They've got more work to do. I get that. Yields up at the front end. What kind of numbers do you think this 10-year could challenge? 320, the high of early May. Where do you think this is going?
Yeah, I see no reason why the 10-year couldn't get to 350 at least. And then, of course, if you whistle by the graveyard and you don't go into recession at some point in 2023 or beyond, you certainly could go higher than that. But for me and for RBA, I think it's more about the secular shift of rates and inflation. You know, for 40 years, you had lower lows and lower highs as you step down with each economic cycle. And more likely than not, what you're going to have going forward are higher highs and higher lows on yields. And so, of course, during the next recession, yields will fall, inflation will fall, but coming out of that recession, they likely go higher than the previous period. And so for the current economic cycle that we're in, maybe it's 350, maybe it's 375. You know, it'll be hard pressed to get to 4, I think. But, you know, again, if this cycle has another 2-3 years from now to run, then you certainly could. So I don't think 320 or 317 is the high on the 10-year. I would expect, you know, 325, 350 as the next level to be looking towards.
Mike, just quickly, I think you've touched on the heart of the problem for a lot of people. Still now, there's a view that a lot of this is temporary, painful, but temporary, and that this can't persist. It will fall on its own weight. You're pushing back against that, aren't you? You think the dynamics we're experiencing now can persist for a whole lot longer than people think?
We truly believe that the 40-year and the 40-year bull market in treasuries is dead. You know, died 2 years ago. We hit 50 basis points on the 10-year, August 4th of 2020. It's been a pretty steady rise up. You know, Chair Yellen, I'll still call her Chair Yellen, she really disappointed a couple times in the last few weeks. Now, she didn't mention the biggest driver of inflation, which is all the QE dating back to the global financial crisis, then layering more QE during COVID, plus all the fiscal stimulus. I mean, that's very similar to what we saw in the 1960s around the amount of monetary stimulus used to fund the Vietnam War, and then coupled with oil embargoes of the 1970s. That's exactly what's going on now. And she didn't even mention it. She wants to blame Putin in Russia and Ukraine and supply chain constraints. And they still have this mentality that things are transitory. Well, if you believe that, you know, going back to the crisis, this was a problem that started then hey, it's going to be around for a while.
Mike Kontopoulos, Julie Bill, to the both of you, thank you. Coming up, the morning calls, and later, Exxon, $100. That conversation coming up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that. Bloomberg Television. Top experts. Great questions.
From New York, let's get straight to your morning calls. Bank of America downgrading target to neutral, highlighting competitive pricing and weaker margins. Morgan Stanley downgrading Altria to underweight, expecting higher gas prices to pressure consumers. And finally, BMO naming Amazon its top pick within the mega caps, expecting shares to rally in the second half. Coming up, JP Morgan's David Stubbs, your opening bell, is up next.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
24 seconds away from the opening bell in New York City this morning. Good morning. Futures lower, just a little bit, negative by 0.4% on the S&P. On the Nasdaq 100, down 1/3%. On the Russell, squeeze that in, down about 0.5%. From New York, there's your opening bell. Switch at the board and get to the bond market. Yields look a little something like this. Higher by 3 basis points to 3% on a 10-year. Getting comfortable with a 3 handle on a 10-year the last couple of days. Euro dollar 107.37, positive 1/3%, going into the ECB tomorrow. And crude, finally a break of 120. 120.23, up 0.7%. That's the cross-asset price action about 15 seconds in. Here are your movers. Here's Abby.
John, let's take a look at one big laggard this morning, and that, of course, is Intel. Shares have been cut at Citi after the management is basically talking down the quarterly outlook. We've had so many companies recently pre-announcing to the downside. Intel doing it in a softer way. That chip stock down 3.5%. Western Digital, on the other hand, up 4.2% as they are considering a breakup on pressure from Elliott. They would basically divide their business into 2 companies, the flash memory and then the disk drives. Roku up 5.1% as the insider sell window has closed. So essentially employees cannot sell shares. More at stake. Analysts like this move quite a bit. And then Alibaba up for a 3rd day, up about 4% as China has approved more games. So we've seen this big rebound. There's a debate now whether or not this is a viable bottom here for China tech. The contrarian, however, John, who a while ago said that the technology China tech would keep selling or would sell off, and it certainly did, down more than 50% at the lows. He says this is not a viable bottom. But
that
today,
is a top pick, though, for Marko Kolanovic over at JP Morgan. Abby, thank you. A top pick. China ADRs for him. Big tech right now. Where are we? Information technology, middle of the pack, down about 0.6%. Energy, top of the pile, relatively speaking, up by 0.05%. Overall, the S&P 500 down about 5 or 0.6%. Crude up in a big way this year. You know that already. Energy equities as well, up 60%. More than that this year alone. Taylor Riggs has more. Hey, Taylor.
John, briefly yesterday hitting 120 on crude, and that trend continues today, now trying to hover near that $120 or so a barrel. And so really the story of the year has always been about the energy sector. The themes for the days continue really as the theme for the years. You highlighted that sector. I think what is crazy, and you mentioned some of these statistics in the introduction, crude is up 125%. So when I take a look at the S&P 500 and you're taking a look at the best performers, and it's the energy sector up 65%, that blows you away until you realize that that gain is half of what the actual energy crude really has gained here at more than 120%. So typically if we think about correlations, maybe one would expect a little bit more of a better performance here for some of the energy stocks when you think about the actual performance of energy. I think what is so interesting, though, is you're actually getting some of the intraday stocks here hitting record highs. I think you had Valero yesterday, another price target increase. ExxonMobil was at another record high yesterday. And so some of the individual stocks are actually doing really, really well underneath the sector surface, though, even though perhaps maybe the energy sector only up 65% with the huge gains in crude that you've seen.
And Taylor, very disciplined, seemingly no interest in building out capacity.
Nope, it is all about cash flow, returning money to shareholders. That has been the theme of the decade, maybe, and that certainly has been continuing this year.
Taylor Riggs, thank you. Thank you very much. Just one sector to keep an eye on, of course, through the year. Katie Lyons, it has been very different over the last couple of years compared to the previous decade.
Yeah, growth has dominated for so long, John, and we've seen a couple of false starts, head fakes, where we see a period of value outperforming dramatically. It never really seems to last. The question is this time different? Because once again, this year we are seeing value outperforming as we have the specter of higher rates, which puts pressure on higher multiple, higher growth companies. We actually have the S&P Value Index only down about 4% this year. Its growth counterpart is down 21%. So that puts value on pace for the widest margin on an annual basis of outperformance relative to growth in any year since 2000. And value has now actually regained all of its losses relative to growth since the pandemic began. Now, of course, that's reflected on a sector level. Taylor was just running through how energy is far and away the outperformer. Note what is the underperformer. The three worst sectors in the S&P 500: discretionary, communications, and tech, all of which are, of course, tech heavy. So growth stocks are obviously dominated by those tech plays, and we have seen those tech earnings projections slashed. We had Microsoft last week cutting its estimates, talking about FX headwinds. We've seen a number of companies from Meta to Tesla maybe freezing hiring. And overall, Bloomberg Intelligence says that since mid-April, growth stocks earnings estimates have slid by 7 percentage points for the second quarter. They've been cut for the second half too. Meanwhile, values estimates for earnings have gone higher. The one thing I will say, though, when we're talking fundamentals, John, valuations for growth companies were around 30 about 2 years ago, now down at 21 for a forward PE multiple. So yes, these stocks are still relatively more expensive, but they've gotten a whole lot cheaper, John.
Kelly Lyons, thank you. How's this for a story? Some reports from a Swiss finance blog that State Street could make a 9 Swiss franc share bid for Credit Suisse. So that means we were down hard over at Credit Suisse, and we've erased much of that loss following that report. Taylor Reese, let's catch up on this one. What do you see? What have we heard this morning? And what do you make of the latest development?
Yeah, John, so this is interesting because we were going to be coming on and talking about Credit Suisse and potential job cuts. And this is sort of an interesting story when you think about all of the cost cutting and job cutting conversations that we've had really throughout the industry. We've talked about retail being one of those. And then, of course, Credit Suisse warning about a third straight quarterly loss and potentially then getting some job cuts and maybe trying to blame some monetary policy. But analysts saying that a lot of this was self-inflicted wounds. And then, of course, a lot of those losses, as you just mentioned, being erased, trying to turn positive now on a potential bid. So I think we're going to dive deeper into this, but really interesting on the heels of sort of the announcement this morning of looking at perhaps maybe some more cost-cutting measures, trying to make perhaps some more attractiveness, some more value generation underway, John.
Taylor, thank you. Let's catch up on that again in about 5 or 10 minutes. Just to repeat, the report comes from a Swiss finance blog called Inside Parade, citing a single insider, just to give you an idea of what's behind this report. Bloomberg has reached out, of course, to State Street for comment. We haven't received that comment so far. We've reached out to Credit Suisse, of course, for comment. They declined to comment when contacted by the team here at Bloomberg News. So the report, citing a single insider from a Swiss finance blog called Inside Parade, saying that State Street could make a 9 Swiss franc share bid for Credit Suisse, and that offer could come as soon as the coming days. So we were down hard on that name, and now we're down just 1%. We'll continue that conversation in just a moment. But the broader equity market, we are down about 0.5% on the S&P 500, and we've seen many cuts to the outlook. Here's the latest from David Stubbs over at JP Morgan Private Bank, 4250. Down from 4,500. Goes on to say a good chunk of the recent decline in stock prices is attributable to a marked drop in distant earnings. As a result, we revise our year-end 22 S&P 500 outlook to 4,250. David, great to catch up, sir. Good friend of the show, good friend of mine. Let's work through it. 4,250. Why? Basically, no gains for the rest of the year.
Well, sure. Good to see you, John. In discussions with our equity team, about the outlook, I think we see some margin compression ahead, for sure. we absolutely are in the camp that the growth is going to slow. Our economics team, pointing to sub 2% growth next year for the US economy. You put those two things together, as well as some, some question marks over how high the Fed can go in their policy tightening, and you get to, as you say, a rather modest outlook for us. I think the point on the longer term earnings one is a very interesting one. As we've seen, next 12 months earnings have continued to grind higher over this year, and the equity team are absolutely pointing to sectors such as healthcare that have that resilience over the earnings pattern. But if you look further out, estimates of 3 to 5 years growth, which are present in the market, have come in quite a bit. And that, firstly, for us, reflects a little bit of a correction after huge optimism built up post-pandemic about some of these digital trends. But most of that now seems to have actually happened, and we've seen now that no reason why you can't have good productivity growth for this cycle. No reason why the long-run trajectory of America has changed. So I think that's an important aspect to this decline we've seen in growth stocks this year.
So, David, last time we spoke, you said a softish landing is still the base case for you, and people will be struggling to reconcile that view with this view of limited upside on the S&P 500. How do you pair the market view with the economic view? You touched on it there, David. Just build on that a little bit more.
Sure, John, it's very simple. If nominal GDP is going to slow from its torrid pace in the last few quarters, and yet things like the labor market, wage growth are still going to be reasonably robust, you get a compression of margins. And that's why you can have absolutely economic growth next year of below trend. Let's be clear, like we're calling for, I think, 1.4% growth next year. That's below trend for the US economy, whilst having a pretty muted earnings upside from here. And we will need, I think, to see a clear turn in optimism about corporate earnings, clear signs that the Fed won't have to go, say, above 3%, clear signs that margins reach a bottom before the equity market will rally sustainably. Now, look, in that time, John, you're going to have tradable rallies. And if you're watching this program and you're a trader, I'm sure you can absolutely make hay in those. But before long-run investors really find a bottom, I think they need to see a few of those things together. So if you put a weak GDP number on earnings growth, it really happens to be not the most exciting outlook for equities on a market-wide level, but certainly some opportunities now for traders and indeed for some long-run investors.
And on the other side, in fixed income, in bonds, David, are you more confident in this idea there's more upside in treasuries than perhaps there is in equities, that we can get a decent rally here in treasuries now, that this is the place to be again, that bonds are back? Can you say that?
Absolutely, John. We've been saying that for a few weeks now, having a lot of conviction that when the 10-year is north of 3%, it's time to add, especially if you're holding a lot of cash. I think this represents an important evolution in the market drivers. Last year, 3 to 4 to 5 months, we've seen bonds be the issue. They were the ones selling off, raising the discount rate, hurting the equity multiple. We're probably at peak hawkishness right now. We think that the correlation has started to flip. The bonds can protect again, and so we are advising adding to duration when you can get more than 3% on a US 10-year. Don't get me wrong; certainly further losses would be possible if the inflation proves a bit stickier. And Friday's CPI report absolutely crucial there. If you get more hawkishness around the world, the ECB tomorrow, for example. So it's obviously not a one-way trade, but we think there's an asymmetry here, that if you are looking for a severe slowdown in growth next year, bonds are going to help protect your portfolio in a way that they haven't in the last 5 to 6 months. So that's an important evolution now. Now the focus is on how deep will the economic slowdown be, how deep will the margin compression be. We're obviously pretty cautious on those fronts, and that's why we're advocating clients that don't have a lot of duration in their portfolios to start to add.
Bonds are back, according to David Stubbs. David, stick with us. I want to talk to you about the ECB in just a moment. Coming up on the programme, we'll do that, and State Street potentially making a bid, maybe later this week, according to a report for Credit Suisse. That's next.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
But when we think about the banking sector in general, higher rates should help them, depending on the business model of the banks, but in general, it should help them in enhancing their net interest income. Of course, it's the other side of the coin. As we increase rates, that some of the borrowers may have more difficulties confronting their obligations.
The focus on the European banks, a bit of news from Credit Suisse earlier this morning, a bit of news again in the last 10 minutes with the latest. Here's Taylor Riggs.
John, I want to be careful here, of course, as we're citing a Swiss finance blog. State Street may be, according to this report, offering to make 9 Swiss franc a share bid for Credit Suisse here. Now, when I'm taking a look at some of the Swiss franc shares here, I have about 680 or so. So hugely negative. And then as you can see there, a spike higher, trying to gain here on the day on that report. I think what's interesting is before this and before sort of that big move upwards, the story really has been about a bank and a turnaround situation, warning again about another loss. And really then looking at cost cutting and job cuts, and something that, John, that we've heard really sort of globally and in multiple other sectors, and maybe sort of now hitting this sector as well. I think sort of another interesting story behind this is they're citing monetary policy, significant tightening that's underway. And I know that you're going to talk about the ECB, and yet Citigroup coming out and saying that, well, a lot of this could be self-inflicted. So again, sort of the big news this morning was really coming into this story, the big job cuts, a turnaround, another loss for the bank. And then, of course, a big move higher here on a Swiss finance blog report that 9 francs per share could be bid from State Street for Credit Suisse.
According to a single insider, that finance blog, and of course we're waiting for some confirmation from either party here at Bloomberg. We'll keep you on top of our reporting. That's some of their reporting out of Switzerland at the moment. Taylor Riggs, thank you. Brilliant work this morning, as always. Looking forward to the close a little bit later. That is the story for Credit Suisse. Here's the story for the ECB. Matt Miller, we might see something in the next few months that we haven't seen in a long, long time.
Yeah, and I think the key phrase there is in the next few months. The sloth is unbelievable. I was just looking at the rates, John, and the last time they were positive, Barack Obama didn't have any gray hair. He was in his first term. The hit song was Call Me Maybe by Carly Rae Jepsen. Tesla hadn't yet delivered its first Model S, and my friend Kriti Gupta was celebrating her quinceañera. So it was a long time ago. This is the inflation picture right now at an all-time high. That is, of course, since they started measuring the entire euro area inflation, but still 8.1%. It's a huge concern. The core in blue there at almost 4% is a real concern as well for the central bank, especially for the Germans. They are so far behind the curve. Take a look at where the ECB is compared to the BOE and the Fed, and it's like they haven't yet gotten the call. In fact, right now the debate seems to be whether they hike by 25 basis points or 50 basis points, but not at this meeting tomorrow, rather next month, and really in a month and a half, because that meeting is at the end of July before the August break. The one thing that they could do at this meeting which Christine Lagarde signaled in a blog post earlier, about a month ago, is start to unwind their balance sheet. This ECB balance sheet towers over everybody else's. I mean, 8.8 trillion euros, it's bigger than the Fed's, and they still haven't started to unwind it yet, even as we've seen rates jump. In fact, if you look at bonds, the gains that we've seen this quarter are going to be the biggest quarter we've seen in a century, or this century, I should say, not in the last 100 years. But it's pretty amazing, the picture there. So I think everyone's going to be glued to this meeting tomorrow.
Matt, this was nice. It's been a while, hasn't it?
Yes.
Looking ahead to the ECB. We should do that again. Matt Miller, thank you, buddy. It's good to hear from you. Matt Miller on Bloomberg Radio with Paul Sweeney in around about 10 minutes' time. David Stubbs back with us from JP Morgan Private Bank. David, we haven't seen this since 2011. We've had negative rates since 2014. Your point, your view on the big change that's come in from this ECB?
You're right, John. Absolutely historic stuff coming soon. And I think that there is an understandable desire to rapidly get away from negative rates. No one wanted to get into negative rates initially. It's this kind of crazy situation to be in if you're a central banker. And so I would expect them to get away from that fairly soon, probably 25 basis point hikes. I don't see a 50 there, but I think that is bait in the cake getting back to zero. I think there's a couple of things, though, which make us a little skeptical that what's priced into the market, i.e. their policy rate getting close to 1% in the next few quarters, is getting a little ahead of itself for a couple of reasons. Firstly, this central bank has a terrible record of hiking just at the wrong time. They hiked in 2008, just before the financial crisis. They hiked in 2011, just before the European banking crisis. They know that. They don't want to do it again. And then, of course, we still have, despite some very significant improvement in balance sheets and internal structural arrangements, some weaknesses in the Eurozone. Obviously, the periphery. Look at the spread between the Italian debt and the Bund. It's risen significantly in the last few months and quarters. The ECB is aware that they can't push the Eurozone as hard as other monetary areas, because it's not like other monetary areas. And so I think those two considerations are going to still leave an institution, as Matt pointed out, incredibly cautious, happy to be behind the curve, happy to see evidence of inflation pressures building domestically, and still moving methodically in the next few months.
The Italian bond market they want to worry about, you mentioned it, David. And of course, the Federal Reserve doesn't have to worry about that. And the Federal Reserve gets to look at a much more resilient labour market too. I'm looking at yields higher now by 11 basis points at close to 340 on an Italian 10-year. Let's finish here, David. Do you think it's going to be difficult for this ECB to get much above zero on the depot rate? Do you think that's going to be a challenge in and of itself?
We see them hiking a couple of times above zero, so 0.25, 0.50 into next year for sure. But then the outlook is so uncertain because of the energy issues. How big a hit is this going to be? Are we going to see the Eurozone on the verge of a recession as we move into next year? Are we going to have rationing of energy and shortages and rolling blackouts, as some people are talking about, John? So I do think that they are mandated to focus on inflation. Remember, they don't have a dual mandate, unlike the Fed. They are solely focused on keeping inflation close to their 2% target and a bit below it. They have the core inflation there that is way too high. They need that to stabilize and start to come down. We think that's going to play out over the next 6 to 9 months. So we see them getting a bit above zero, but maybe not as high as the market is currently suggesting.
They do have this kind of shadow mandate, though, don't they? This unofficial mandate, if you will, and that stability in the peripheral bond market. David, Matt mentioned unwinding the balance sheet. How are they going to do that?
John, I think it's really interesting in this coming press conference tomorrow and in the next few months, if they try to lay out a stability-focused bond buying mechanism, i.e. something that is out there with clear criteria, probably quite exacting criteria, for them to restart the bond buying that they're just about to stop, but one that's focused on stability only and not on the inflation mandate. Remember, the buying of the bonds so far has been tied up with the overall macroeconomic goals. But you're right, the instability of the periphery will continue to stalk this central bank. And that is, I think, going to put a cap on what they can do on the deposit rate. I think it's something that they can and will and should address directly in some kind of facility set up to trigger further bond buying of the periphery if they see a genuine domestic reason to do so. I think that's the incredibly tough balancing act this central bank has to pull off. in a way that almost no other central bank has to.
David Stubbs of JP Morgan Private Bank. David, good to catch up, mate, as always. Up next, your trading diary from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Six minutes into the session, a raise in losses, basically unchanged now on the S&P. A busy week ahead. Let's get to your trading diary. Secretary Yellen, repeat, Volume 2 on Capitol Hill at the top of the hour. President Biden leaving for LA to attend the Summit of the Americas at 11:45. An ECB rate decision and President Lagarde news conference coming up tomorrow. And we get another round of jobless claims too. Then finally, the main event, US CPI. Coming up on Friday. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in 5 stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Wienergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Wienergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away. Because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I'm interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tekken right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African-American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest flight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, and language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As well as describe about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. At Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools.
Wow.
So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
They're stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well